Good morning, everybody. We will get started in about 5 minutes. If you are just joining us, we'll get started in about 4 minutes. Keep your eye on the chat. We will post materials links there, and we're going to keep it on mute for a minute until we get started.
Michelle, are we on?
We are. You ready to get started?
I've got it at 10.
All right. Hello and welcome to the webinar. My name is Michelle Pierce and I will be producing today's webinar. To reduce background noise, we start all attendees on mute. However, questions and participation are encouraged. So if you have a question for Les, please post that in the Q&A. And if you have any questions for me, you can put them in the chat. A quick note about CPE credit. We are required to monitor attendance. So we do this by using pop-up attendance polls. There will be 3 random polls per hour. And in order to get full CPE credit, you'll need to answer 2 of the 3 polls. And I will leave those polls up for at least 5 minutes. So I'll launch one of those now. There we go. So you'll just need to reply to that. Some systems block that pop-up. So when I launch a poll, if you don't see the pop-up, I will also put a message in the chat like this. So if you didn't get a pop-up, you'll just need to reply here in the chat and I will note your attendance that way. CPE certificates will be mailed to you within 3 business days. So Les, that's about it. You can take it away.
That's about it. Take it away. Good morning, everybody. It's I don't know how the weather is where you're at, but today it is absolutely the perfect Utah weather. Frankly, I've never been home in October or September as much as I have been this year. It's a very strange thing to be home once in a while. And I'm having problem with my Zoom webinar material here. Stop sharing. So it's a beautiful day here in Utah. It's going to be about 83 degrees. It's unseasonably warm. Should be about 71 for the day. But anyway, we're here for webinars. The next 4 hours, we're going to be talking HUD 101. The introduction from Michelle. Michelle is the producer here today. We have found that, her and Kathy are really kind of tired of listening to the shtick here. They are monitoring my behavior most of the time, and they're looking generally for things to share with you. They will continue to post materials or give you direct links to the materials for things that I show. Most of that should be available in the links that were already posted up above. So if you're looking at the materials in the chat, you can see the materials to be downloaded. Our theory for today is, a 400-minute, 200-minute class. Sorry, don't want you to get excited about 400 minutes. It's a 200-minute class. That's 4 hours of CPE, 4 50-minute segments. So we are geared up towards that. What we're going to do, though, to make this work.
Les?
Yes, please, Kathy.
This is Kathy, and I just wanted to make one more comment about the CPE credit. Just because there's more people than normal commenting here in the chat, which is fine. I just want to make sure they understand they don't have to comment here if they see the pop-up poll attendee thing. And if you don't see it, you might want to just hover over the Zoom window, see if there is a little icon at the bottom of the window that says poll, and click on that, and you'll see the poll. Or you can keep typing here. That's all.
In fact, I think one thing, Kathy, can't you go up to the Zoom window, click on the polls, and it shows you the current poll or what, like that poll's been going?
Yes, and if the poll's over, that poll icon disappears.
Yeah. Now, the other thing about this, just to assuage any kind of concern you may have about all this, because there were a lot of here's, you only have to get 2/3 of these for the day. I mean, for essentially the day. We are not monitoring, I don't think, 2/3 every hour. You know, we're not running that kind of a process here, to my knowledge. And the polls do stay up for an extended period of time. So the current poll that's been running, that apparently only 9 of you cannot see, because only 9 of you have not answered. Well, and that might include us. So that, no, it doesn't include us. That's already been up for about 5 minutes. So there's plenty of time, as long as you're, you know, not out in the garden for 2 hours, you're not going to miss too many polls. So now I did want to just mention, we're going to try to do this in 2 100-minute segments. There has been, you know, a conversation about trying to do it in, what is it, 3 65, 66, 67-minute segments, you know, 68-minute segments. And have 2 breaks in the middle. I don't know. Maybe, I'll tell you what, maybe it's either this, 2 10-minute breaks or 1 15 to 20-minute break in the middle. And I think that the 15 to 20-minute break, we'll go to 20 today, is probably a little better. You can get up and move around your house, your office, get coffee. If you need to make a quick trip for relief of coffee, then that you should be able to do all those within, grab snacks, all within the time the polls are up, open, and so. Okay. Another webinar I attended did not allow you to see the poll if you were in full screen mode. Ooh, I don't know what that would be. Yeah, that might, you know, we've had, a lot of people are having different experiences with Zoom. By the end of the year, you're all going to be Zoomified anyway. So good luck with all that. Anyway, we're done. We need to move on. We have a lot to do today. So I think what we're going to try to do is go 100 minutes, and then we'll take a 20-minute break, and then finish up in 100 minutes, and that will lead us into part 2. So today, this is the introduction to HUD audits, HUD multifamily, I guess I should say. But in one way, pretty much an introduction to anything HUD related. There are differences between each of these things, clearly, than what you see here. But I want you to understand, this is the AHA CPA view of how to understand a HUD audit. Now, there are different ways to come about this. We really do a lot of submissions. So I don't know what our submission count is right now, but we might be doing over, you know, 1,500 submissions a year that Kathy is really in charge of. And we got our groundwork by marrying the CPA side with the submission side and saying, look, let's focus on the financial statements, or the submission itself has an understanding of what really should happen up front, and train according to that. And that's the reason why we are what we are. Kathy is probably one of the, well, if not the premier expert, I think, on how the REACT system works, because when they really want to know how things are going to go, when they have a change, they always call Kathy and ask for that. So that's helped us a little bit to distinguish ourselves from how, in terms of how we understand the audit for a multifamily housing. So what we're here today, we're asking ourselves, and there will be a lot of extra material we'll hand out, and Michelle will make sure those links get put into here. So we'll go from there. Let's see, I've got all my stuff turned off, no distractions. That's awesome. And why are we here? Well, In the good old days, back in maybe the 80s, and that's really a long time ago, you know, we're talking 30 something years ago, when we had compliance audits, HUD has had a requirement for these audits for a significant amount of time. This is not a recent phenomenon, nor is it a recent phenomenon to have every other agency at the cabinet level in the U.S. government require financial audits. In fact, so much so many audits among so many people that they came up with the idea of having a single audit, and they passed the Single Audit Act. And that Single Audit Act was for essentially nonprofits, governmental entities, where they had multiple funding sources to get one audit, you know, and cover the compliance in that one audit by having a risk assessment process among the programs. Well, if you're not a nonprofit, then you are, you know, something else, and the agencies have all come up with ideas on how you should conduct these audits. In particular, multifamily came up with rural development, and both, so from the Department of Agriculture and of course HUD, RD would be kind of seen as a, they don't really like this, but it's got a fewer projects and more the, sometimes people say the little brother. It probably is offensive at some level to say that, but it is a much smaller program, but they're very similar in terms of the content, what the purpose is, how we do this. So anyway, as the government went out and handed out more money and wants accountability. Now, in our case, we're not even necessarily handing out money. We just want accountability because of the insurance program. They looked at how best to get these audits done. And from the get-go, most of this has always been done by an independent CPA. The government has multiple audit arms inside of it, certainly the Office of Inspector General. And for those of you who are newer to this, if you are really in this class because you are a HUD 101 information level person, some people get it for review, some people are here because they're new, and that's fine. We love everybody. But it doesn't hurt to go get our acronym list. This is a list we've put together over time, and if I am saying things that I've default into some acronym, this would be the acronym list, and it's in the materials folder, and I try to never use too many acronyms without explanation of what they are, just because it's non-productive, it's not terribly productive, but that's why. So when you look at this, we have OIG, Office of Inspector General. They have another group called DEC, although they're not formally auditing. They're reviewing for compliance. And we just found over time, the government's found that Marissa, the slides are available right now. They're color versions. They're in PDF, but we don't really hand out the PowerPoint, but they're color slides, PDF, and there's a black and white if someone was going to print the document. So in other words, the independent CPA is the one in charge of most of this, and it's just for a very specific set of reasons. There's an established framework. Gas is already there, and if you look at the other requirements that exist for conducting these audits, they all leverage off of gas, and we'll clarify that here in a minute. There are a lot more CPAs, and they work a lot more efficiently than the government auditors do. And in fact, at one level, the government thought they would do their own audits for rural development. Well, at least the OIG group did. And that didn't get very far, much traction, so that didn't go very far as an idea. It's just nothing can compete with the professionalism the speed and efficiency and cost of the independent CPA. Probably sometimes too cheap, but that's another story. That's why we're here. And the X reason is just simply this. 90% of all compliance that we're monitoring is going to be found in the financial statements. There are very few things here that are being monitored for non-compliance or to detect non-compliance that are not related to the financial statements. And in particular, we're going to talk about tenant files. Tenant files are one of those things that, don't really show up, or where non-compliance doesn't really show up in the financial statements. Almost everything else is derived from a financial statement audit. In fact, it's really hard. The lines between a financial statement audit and a compliance audit in multifamily are extremely blurry, much more blurry than any other compliance audit you will do, by far. Oh, sorry, got to get something warm in here today. Kind of got cool. So we see these Department of Labor. A lot of you are doing DOL audits for benefit plans. Obviously, HUD is huge. There are probably about 25 or 6,000 audits done at HUD. There are probably another 15 or so thousand in the Department of Agriculture with housing or rural electric. I live in a town, well, I guess all of us here in the office live in Kaysville, Utah. Kaysville, Utah provides its own power. It doesn't go from Rocky Mountain Power. That means power is provided by what we would call a rural electric association. We are an REA in Kaysville. We provide our own power company. And there are audits for those. Okay? Almost all these bear some audit requirement, and then you could add all the other cabinet level agencies, Department of Education, HHS, and they would all fall under generally a single audit act. Now, why do these audits work? Well, like I said, first of all, it's this extreme amount of data in the financial statements themselves. So you cannot separate the financial audit from the compliance audit. This is the one big training dilemma for a lot of people in multifamily housing, because they want you to plan a financial statement audit and then plan a compliance audit on top of that. But when we look at the financial statements and the related compliance requirements, we're going to see that it's extremely difficult to unwind those two compliance areas. It's very difficult. Then internal controls over the financial statements are also integral to the compliance controls, and almost every one of these audits makes the auditor test internal control over compliance. That is a different step than when you would get under a gas audit. You would have to evaluate internal control, maybe do a walkthrough, but you are not required to test internal control. But you are required to test internal control over compliance. So again, most of the principles in financial audits, they transfer very, very seamlessly over to the compliance audit, certainly in multifamily housing. Now that brings us to the financial statements, and I like to just start this conversation by looking at the actual financial statements themselves, and this copy is in your materials folder. This is a fairly recent change, and this one's probably a little bit more complicated than a lot of them, just because we're showing different things in here. The first thing you need to notice is that the basic financial statements themselves only run up through page 12. Okay, now that's the stuff we all learn about in school. Get a balance sheet, up through the cash flow, and then the notes to the financial statements. Now there are no lists of mandatory footnotes, okay? in the HUD environment. There is certainly a required chart of accounts by which the supplemental data is measured, or it has to follow that chart of accounts. This is a very unique situation where we have a significant, I mean, this is probably the most significant difference of these multifamily audits, is the vast amount of supplementary data. And that is going to cause us to issue an opinion under AUC 725 on supplementary information. Now, we're going to look at that, and you're going to be questioning why. And to this day, people who've been doing this for 20 or 30 years still ask me the same question: why do we keep doing this? And the answer is because it's required. And it is required. You could get to those in day 2. We'll get to the actual HUD audit guide, and you will see that those requirements are listed pretty specifically for that. Now, if we're looking at it, you get the balance sheet, and that would be the regular GAAP-based financial statements that we're all used to. Then you'll see the supplementary data required by HUD. This is a presentation of certain data elements that get reported in REAC. So what gets reported in REAC is different than what is in the basic financial statements in many cases. Now, in the balance sheet, it's pretty close to the same, but in the P&L, there is a lot more data available in the profit and loss section, as you can imagine, than there is in, say, the statement of income in the basic statements. And then, of course, you add on to this supplemental schedules: reserve for replacements, residual receipts, surplus cash, fixed asset detail, and then a miscellaneous details account, which I will explain later. And it'll be clear when you look at the statements themselves. Then, of course, we end up with a bunch of reporting differences. So the first thing is we have to do a report in accordance with the Yellow Book. The Yellow Book's going to make us, it's going to do a couple of things to us, and we're going to go over it. It's going to say, look, you have to maintain some form of measurement of your competency, and that's going to be CPE. You have to be more independent, and they're revising the rules all the time on independence. The next thing it's going to do is it's going to make you report on internal control and compliance at the financial statement level. And it also gives you a framework for reporting findings. Then you see us give an audit report on compliance for each major program. In that document, we're going to do two things again. We're going to actually give an opinion on compliance for the major program. Now, in our case, major programs would be either anything over $500,000 for a for-profit, or over $750,000, and Chosen has a A or a B program, I mean a high-risk A program for single audit. So in this case, this is, we would be looking at something a little more based on HUD audit guide today, but we're blurring the lines a little bit with this set of financial statements. Then you get a schedule of findings and question costs and recommendations. And then you have a schedule of prior audit findings and question costs. And then we're just highlighting each of these requirements with the boxes that you see here. So just trying to highlight what those different requirements are. Now, the financial statements are not the basic auditor's report. We have to add here that the audit is performed in accordance with the Yellow Book, or GAGAS, Generally Accepted Government Auditing Standards. And of course, then we would get down and give an opinion as we move further down on the financial statements. And then you see this other matters paragraph. This is the report language required by AUC 725 on reporting on supplemental information. And all of that supplemental information we give an opinion. It does not have to be the same as the basic financial statements. What our opinion says is that the supplemental data was derived from and relates directly to the underlying accounting and other records used to prepare the basic financial statements. So we don't call the supplemental data financial statements, we call it financial statement data. Yay. Then, of course, we could identify any other information, and finally we end up with our report listing a reference to the Government Auditing Standards report. Luckily for this year, for 2020 year end, these reports don't change materially. Okay? As we get to the new suite of audit standards, making of the rounds, which were deferred for COVID, at least until next year, maybe longer, that means there are no changes to these reports for the 2020 year. And that's awesome. We're happy to have that go on. Oops, sorry, I've been changing the wrong slides here. Okay, now the financial statements. There are multiple ways to do this. We can end up with a real estate focused financial statement instead of a classified balance sheet, where we would start with PP&E at the front and then come down to current assets. 90% of all people, though, do this, and they do not have to be comparative. So you will list this down, and of course now we have a section on restricted cash or restricted deposits that most people are defaulting to due to the change last year in the cash flow. But the balance sheet itself is really quite basic. If you think about it, I have the fixed asset list, okay, with depreciation. I have restricted deposits, and almost the auditing for these restricted deposits is 90% covered in the testing of the mortgage. Receivables are usually very small. This year may be one year where that is not true. And we're running with a lot of cash, hopefully, and then miscellaneous prepaid expenses be small. This is a very simple balance sheet. From the P&L side, we've made this one, from the liability side, we've made this a little more complicated in that we add multiple layers of different notes. So accounts payable is pretty big, liabilities, mostly those are payroll related, interest, other interest, short-term items, prepaid revenue. You will notice that we do split out the liability for tenant security deposits here, and then other loans and notes. Now some of these are payable from operations, and we're highlighting the fact here that some people will have notes that are payable only from surplus cash. It's much more rare, but they do exist, and they exist for multiple reasons. In those cases, HUD has approved the mortgage, given the security interest HUD has in the project. They would approve the ability to take on additional debt for a particular reason, but limit the repayment of it to surplus cash generated by the project. So balance sheet's pretty simple, and I can't spell payable up there. The P&L, again, very basic. Now this P&L typically mirrors the lines in our supplemental data, as we'll get down to that. But the business is really quite simple. I have a friend who really does a lot of management consulting in this area, and he says this is really simple. Here's what you do. You rent the building, you collect the rent, you maintain the building. And that's pretty much what multifamily housing is. It gets a little more complicated than that. But that's mostly what these projects, that's the basic kernel of operation here. Lease the unit, collect the rent, and maintain the unit. And if you can do that and keep it above 93% occupancy or 94 and control your costs, you're going to make money. Well, at least that's the theory. Now, a statement of partner's capital, and the cash flow. Now the cash flow, what you will generally see here in most financial statements for multifamily is that the cash flow is a direct method cash flow. Now in theory, I may not have to do the basic financial statements in a direct method cash flow, but the HUD version has to be direct method cash flow. So this is what we were showing here, has a direct method cash flow. It's kind of a mini cash P&L, cash received for these things, cash paid for these. Now here I've just simply shown what used to be here for HUD. These were removed due to the changes in GAAP last year. And so from a basic financial statement perspective, these two accounts are shown in well, they're not shown in the basic statements, but they're shown in the REAC statements. And so the cash now is rolled into the beginning and ending cash, and you'll see the cash, restricted cash, and equivalents moniker. But that's a cash flow statement, pretty much in the direct method, which then has the operating cash reconciliation here. And that should be pretty consistent. Okay, the footnotes. I'm not going to stop a lot on the footnotes. You can see that I've highlighted revenue recognition for last year and how it is impacted by ASC 606. We could also have revenue under ASC 958 if they were considered to be contributions or conditional contributions. And there is plenty of that around, by the way. I don't need to really stop a lot on too many of these. This was just the last year's stuff. Now, mortgages, when we look at this mortgage, as I mentioned in the note, we will refer to these as HUD mortgages. But Angela, HUD still require the breakout of each restricted cash account for the submission? Yes, they do. Everything is still, you have an escrow account, you have a security deposit account, you have a reserve for replacement account. So as far as HUD is concerned, none of those accounts went away. They only go away in the basic financial statements. In the supplemental financial data, they still exist. And that's one of the things that's caused this to be different. And in fact, in our basic statements here, there was no requirement for us. We left this way simply because it would help us reconcile or show the difference when we got down to the supplemental data. At some point, we did consider that we would just include a line up here, cash and restricted cash. But there aren't too many practitioners who want to show those lines together to infer, you know, what is what, and having to go to the footnote to break out operating cash from the escrow cash or the security deposit cash. So what most people did was they came down to either one restricted line like I'm showing here, or they left out security deposits and reserve for replacements separate anyway. So nobody was really combining those up into one line cash account. It's a great question. Then, you know, of course, we would have come to the same reconciliation anyway in the footnote under the new GAAP. And that balance has to equal the cash flow. It doesn't have to equal the balance sheet. This breakout has to be the items, but this total has to equal the cash flow. So these are not HUD debt. This is just HUD insured mortgages. The HUD government never loans money here. They never, ever, ever loan money. That's not, RD does in rural development, they loan money. But in HUD's world, they have stopped, they haven't lent money for probably the last 25 or 30 years. Now they give grants, that's true, but they do not have any mortgages anymore. Well, other than those they're still servicing. They are not issuing any new ones. So they're not really HUD mortgages. The management fee, things like that to disclose. And then you get to the supplemental data. Now this data is what it goes into REAC. And REAC is the Real Estate Assessment Center. It's the repository for all of this data and a system to analyze the data. Now, when you get this finance, these are all very heavily designed accounts to allow HUD to get a piece of information. Okay, Angela, the balance sheet as you're showing it, is it acceptable to use this as the financial statement presentation? Look, I'm going to be honest. People do try it. In particular, what they will do, look, the balance sheets aren't that different. So if I come to the balance sheet, you can see that this is not that different than what we may have had up above, with only really one breakdown. We would add those two numbers. We would add this together up above. We would not necessarily break out the net receivables. Okay, we had the miscellaneous prepaid. We did have cash, and they'll even put these account numbers up here. Then they go to the P&L, and even on the balance sheet side, or sorry, liability side of the balance sheet, it's not that different. When we go to the P&L, this is what they would generally show has supplemental data. So people do use the balance sheet that way, and the only supplemental data they will show is the P&L data, because the cash flow is pretty close anyway. However, there is a very basic issue with regard to doing that. It's essentially not really, it's against the audit guide. So people do it. I don't know exactly their justification for doing it, other than why do it twice? I mean, I get that part. But if you read the audit guide, it implies that these things, well, it's not even an implication, it's a straight up saying these two things are different. So you end up taking an additional risk there that you may not have to take, and you're certainly going against the majority of the people. So if you were going to peer review, your peer reviewer would be much more used to seeing what I'm showing, rather than if you use that balance sheet and cash flow up in the basic statements and only had a P&L in the bottom, or the back in supplemental data. Now, just for fun, let's look at what the audit guide does say. We're going to jump here a little earlier, but reporting requirements. Okay, you get, it's really 90 days. In addition to an opinion on the basic financial statements and supplemental data, the auditor is required to issue a minimum report on internal control, will certify this, blah, 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 about the AI CPA. And then you say this, you'll issue an auditor's report. And then you're going to issue basic paragraph to the auditor's report. Supplemental information includes the REAC financial data templates, which essentially includes support detail for the specific accounts in the basic financial statement data. And then they're all described in UFRS, Uniform Financial Reporting Standards, and the audit guide goes on in another place to basically describe that. So, Angela, although it is done once in a while, it's not done frequently, and it's not, in most opinions, certainly mine, it's not the best way. Like I said, we see about 12 to 1,500 submissions. I don't know what it is right now. And if I were just to ask Kathy, how many of those do not show that data? She would say it's less than 2 to 3%, and we really, are not happy when that shows up, because we have to make all this other stuff up. But that just tells you, not that that's your problem. It just means that the percentages are 97, 98% doing it just the way I showed you. That is the REAC way, the HUD, do it the HUD way. but we do see other things. It's not as wonderful as I'd like it to be. P&L wise, now what's the best thing about multifamily housing? And this is a unique thing. We always are in a place to measure the actual dollar value of vacancies. So when we get into REAC, we are booking what we would call gross potential rent. Now in this case, gross potential rent is really the combination of these two numbers here. In fact, if I'm going to make a comment box, no, that was wonderful. That didn't work the way I wanted it to do that. Anyway, so that would be gross potential rent. So that is typically what I guess I would add here is that gross, oh my heck, come on, just let me type the text. Good gravy train. How about just regular text? Good. Multiplied by unit rent. Well, that didn't type anything. Equals units per bedroom size multiplied by the bedroom rate. So if you're asking about this, I have 15 units that are 3-bedroom, I have 25 units that are 2-bedroom, and I had 22 units that are 1-bedroom or efficiency units. And the rent's different for each one of those. So I take each one of those times 12. So X times Y times 12 equals the gross, and sum them, and that's the gross potential rent. Now, if it's a subsidized project, all we do is we back off the subsidy amount received, and the difference is gross potential rent on the line item. Now, special claims revenue is for projects who have a certain vacancy problem that they are allowed to justify booking additional subsidy under HUD's rules for that. And the vacancy is the amount we are out. So in this particular case, we love this because if I were just to take that divided by gross potential rent, 4395, 408, and I haven't just done that per se. I'm just going to do it by the full 4589, 378, which is not, I wouldn't normally include special claims. I'm about 95.8% occupied. And I had $190,000 of vacancy loss. That tells you, that's a measurement of that. This is an important thing for you to understand when you think about auditing. Because when you look at cash receipt risk, what's the risk? Plus revenue misstatement risk. You cannot book more revenue at a project than its gross potential rent. Susan, how do you know gross potential rent for entities that change market rates? You have to go off the lease. So when you go to the rent roll, you're calculating that. I would think what you're really saying is they don't really change on a daily basis per se, as they change based on the leases that we sign on a given day. So when a person moves in, their rent roll becomes now, what you sign up into the rent roll becomes the potential for that unit until the lease either renews in a year and probably has an adjustment clause, or they leave the unit. So although lease rates may change from time to time, they don't change every day for every person. It's not like you're buying, crab legs at market price. you agree to a per unit amount that stays in the rent roll. So on each month, you would just say, here's the rent roll. What is our lease amount? Add it up, and then the next month you might have different amounts. So you'd have to just add the 12 months up. Now, for most of these in HUD, we don't have that much market rate change. And certainly for subsidy, we don't ever have that. I mean, it changes once a year. Okay, so those become a little different. But it's really hard to get above the gross potential rent. You just have to be able to set that limit. So whatever the rental value is in the rent roll, then that would sort of become that decision point for you. And most clients do, by any stretch, maintain rent rolls. Sorry, I'm just trying to get to a search here for something else I was going to do. Let's see if I've got one here that's an easy example. I think this is one. Now, this has subsidy in it also. And this is, you know, I don't know the software. I think this was an
Bless your sound is
MRI
cutting.
software generated package. But so apparently vacant, you know, you see the units that are vacant. Everybody else that's under a lease, they will show their gross potential. And so you just have to be able to get this report and, you know, you sum it up. You can get them for the year. So I've just done the calculation here. That number times 12, and I just picked 1 month. Though obviously it could change, but 85 units, 15 vacancy, that's a ton of vacancy for that. But nevertheless, it would just be this gross potential, and that would be whatever, in this particular case, you know, you're looking at that because they're probably saying they're 1 bedroom units, so they're at 145. There might be something at 832 here or whatever, but that's kind of the same program you're looking at here as anywhere else. So that's how we would get there. Okay. That's an awesome question. I appreciate that. Now, the rest of the income. You have a couple of things here that are interesting. If you'll notice here, 5990. These are anything that ends in a 90 is a miscellaneous account. Man, nobody ever lets me type. Okay, so if you have a miscellaneous account that's above a certain level, like 10% usually, some are 1,000, but some are 10%, you have to show this detail account. So what makes up miscellaneous revenue will have to be shown. We actually, in React, there's a detail link right here that opens up a window. In fact, I'm going to just put this annotation up here. Okay, so you would have this account. There would be a detail link in the actual React system. You would click on it and enter the details that make up that balance. So you'd have to go back to the general ledger and add those up, or enter them separately, or group them somehow for how that works. And you will see that in a couple of these places. This one probably is probably not going to be required, but you'll start to see the breakout of all the costs, utilities, payroll, maintenance. Now, from a equity skimming perspective, you're going to hear a lot about equity skimming in HUD audits. Equity skimming is generally a derivative of some kind of charge by the owner or the management agent that should not have been made. Most of the risk is in miscellaneous admin. It probably won't be salaries. It'll be office expenses, miscellaneous admin, or repairs and maintenance. Those are where the risks usually are. Taxes and insurance, financial expense. And then we get down to the bottom and we end up with the P&L, and we add some Part 2 data in it. There are actually 4 of these accounts, but typically 2 are only shown because that's the only 2 that were used. There might be a third one, S10030, that asks you to include a description of the amounts taken out of reserve for replacement but charged into the P&L as an expense. So that's a particular cash flow issue that we would not normally see here for that. Brandon, I'll tell you what, man, we're gonna really talk about equity skimming as we move along. There is a very long definition of equity skimming. From HUD's perspective, equity skimming equals fraud, and there are some well-defined things that equal equity skimming. But it's much more of a broad concept that we will probably not get to today, but we will discuss on day 2, the next 4 hours, because it takes, it's a 15 to 20 minute thing. Now, let me just say this. Equity skimming is essentially defined to be the withdrawal of any money from the project that is not either a reasonable business expense of the project or an allowed distribution of surplus cash. That's the short definition of it. So there are a lot of methods or ways to get to equity skimming. And it's certainly, there are 2 main points to this audit from HUD's perspective. First is to determine if there was any equity skimming. And second, the issue is whether or not the surplus cash was calculated correctly and that they lived within it, because if you didn't, then it's equity skimming. So hang on to that a little bit, Brandon, and we'll get to a much more complete description of equity skimming as we work through the process. By the time we're done, you're not going to be able to avoid the concept of equity skimming. Okay, now the cash flow you see working out, and we have the other schedules, the reserve for replacement schedule. This is a requirement, and it gets entered. It's pretty much coming from the escrow. The deposits come in, the monthly financial or the mortgage payments. There are a couple of unique things here. The interest must be shown. They must earn interest. And then the 139,000 withdrawal is a audit step. Now, if you had suspended your deposits, and this year we may see suspended deposits due to COVID, that means you were not required to continue making deposits with your mortgage payment to the reserve for replacement account. Now, what HUD does with this is they take the number up above in the P&L. The auditor tells them, here's what should have been made in the, this was the requirement from the Form 9250. We'll get to that form in a minute, but HUD fills out this form every year and tells you what your deposits are going to be. If you get a rental increase, they'll issue a new one and it goes up. So did you remake the $250,459 deposits? So we did, and the template will actually measure this number against the S10020. And if they're not the same, it's going to give you an error message, and it's going to make you book a deficiency down in the surplus cash calculation, or you have to say that the requirement was suspended or waived for a short period of time. So this is what HUD uses to detect all of this non-compliance. If they can't get it out of the basic statements, they just add extra data elements at the end of the P&L to help them, and then they put the schedule in, and the auditor is tasked with writing down both the required debt payment and the required reserve payment, and then we measure against it. Now, the biggest thing coming out of here is the surplus cash calculation. Now, the calculation can either be done once at year end or it can be done twice, once at mid-year. And by the regulatory agreement, we are talking about mid-year being the last day of the 6th month and the last day of the 12th month. This sets the table for how much the owner can take out in the next 12 months. This is one of the places where you will find judgment involved in the audit. And a lot of that judgment will be into things like other current obligations or maybe other cash, okay? For the most part, this is pretty formulaic. Cash equals three things. It equals 1120, 1121, and 1191. So it's cash, can't remember what the other cash is, plus security deposit cash. And that number has to be there. This comes, the 1135 subsidy number comes over automatically. Interest for the next month. Payables due within 30 days. Oh my gosh, we can't put 30 days. It's not 3 days, it's 30 days. Accrued expenses is typically payroll. Prepaid revenue comes over auto. Security deposit liability comes over auto. And you enter this, the other current obligations. And if they're positive money, the client can take out up to $534,064 next year. Now, Brandon, if you take out more than that, guess what? It's equity skimming. Now, if there's a mid-year calculation, it will be included in here also. There are two places in the template for surplus cash, one at year end and one at mid-year. And we will talk much more about this calculation as we move through here. The fixed assets have to be listed. When you have additions, they require a disclosure of the details. We'll see here in just a minute. Now, all we typically see this is what I think most people do, and it's what we recommend. We just list all of our details in a schedule in one place. Some people embed them in the basic financial statements. Susan, how do you know if the surplus cash required is twice a year or only at year end? It's always in the regulatory agreement, when we're going to get to that in just a minute. So let me say it this way. All new mortgages have in the regulatory agreement since 2011, so that's 9 years old. All of those allow for a mid-year calculation, or let me say it another way, they allow for two calculations. Every regulatory agreement that allows distributions allows for a year-end calculation. Most HAP contracts are silent as to distributions, but if they are not silent, they typically only mention year-end calculation. So it's almost always down to the agreement. It will tell you you are allowed. It's not something you can assume. Now, an older regulatory agreement, some from before 2002, may not say that at all. It's a one-time calculation. But since 2011, HUD has been trying to move more on the mortgage side to allowing multiple calculations. Okay, so you would end up with these miscellaneous accounts, so that you can see we're trying to describe all of those for HUD. That would be, that's data you had to enter into the template anyway. And then, of course, you have the reports on the Yellow Book side and down to the compliance side. And the compliance program actually requires you to list the areas of the HUD audit guide that apply. And you are going to give an opinion on those requirements. Okay. Can we say that surplus cash restriction means a partner's distribution limit? It always means that. Yes. Mega, I don't know how to say that, but I'm sorry. It doesn't matter how you define the limitation. And this gets confusing between, say, tax credits or other partnership agreements that put limitations on distributions or say other things. They say, well, you can take this money, do this. Whenever we have a HUD mortgage involved or another HUD surplus cash restriction, those restrictions always take precedent over anything else in the partnership agreements, okay? So HUDs or RDs, either one, surplus cash, just the calculations or definitions are always the limitation on what can be taken out of a HUD project in any given year for any number of reasons. So it doesn't always mean that they're distributions. It can be that there were certain expenses paid, and those expenses were defined to be entity expenses. That means that money has to come from surplus cash. So it's more than just a distribution limit. It is that, but it can include more than distribution limits, okay? So Susan, I think that answers that question. It's in your agreement. We'll see one in just a few minutes. Brandon, we're going to hold off and answer that a little bit further on the next day. And yes, I would say that the surplus cash restriction does mean the partner's distribution limit, but it can mean more than that. Okay, now please don't get sorry. I'm spread across 3 screens, so I'm trying to keep up about that, or keep up with the chat. I appreciate the comments. Those are all awesome comments, by the way. I wish we were live, so that would not be such a problem. I like the live a lot. But so when the audit guide, we test this, we're going to actually give an opinion. Some of these will not apply to you. You only include things that apply to you, that are direct and material. And Brandon, surplus cash, a CARES Act can result in more surplus cash. That is true, depending on how things work. And you had a PPP loan, depending on how that PPP loan was structured. You could end up with a PPP loan increasing cash at the project level, either by directly increasing cash or by just simply reducing payroll. And that could increase surplus cash. But there would be no direct, there's a whole conversation about there being a direct impact from, say, PPP money. As a lot of people don't want to show that has cash or surplus cash in the calculation. They're going to want to put the liability against that cash for now until forgiveness is received officially. But there's a whole other conversation around that causes a little bit of a challenge. Okay, now let's finish up with the statements. Other matters, internal control over compliance, and we get the findings. We're not showing any findings here. We should probably get one that shows the findings. And then we have a certificate of the partners and management agent certification, and those must be filled out. Wow, okay. So that was the financial statements themselves. And boy, I'll tell you, the more you understand about the financial statements, the better off we are. Now, when we look at this, what do we do to audit all of that, these requirements? So we have our particular statements on auditing standards, our SASs that everybody looks at. You have generally accepted government auditing standards, and we're going to talk briefly about that. We're going to go through it quickly. And so we would call that also GAS or GAGAS, single A gas, right? I mean, the AICPA in the materials they have, they quote that generally as GAS, single A gas, or has generally accepted auditing standards, double A gas. You can also call it GAGAS, generally accepted government auditing standards, and for the most part, it's just known as the Yellow Book, because double A gas is hard to distinguish from single A gas, and nobody likes the word GAGAS. So yeah, it's not one of those words we like. Then, of course, you could have the Single Audit Act or agency-specific audit guides, such as HUD or rural housing. Now, for the most part, other than a couple of things about how the compliance happens, these audits all turn out about the same. Now, when you look at this in terms of what you need to understand for our purposes today, the better your foundation in generally accepted auditing standards, the better off you are, because for financial audit purposes, generally accepted government auditing standards incorporate by reference all of the fieldwork and reporting standards of gas. So we're going to talk about the Yellow Book here briefly. Let me go down to chapter 6. Now, chapter 6 is dealing with financial audits. So what it says is, we establish requirements for financial audits and requirements to the statements on auditing standards. We should comply with those. And we're really saying we apply those standards in here. Okay? That is absolutely a known thing. So you cannot do a financial audit in Yellow Book or HUD or single audit without following the statements on auditing standards. That's just the way this works. So they are incorporated by reference above. And then, of course, they roll further up into the HUD audit guide or to the single audit. And by the way, Brandon, we'll talk a little bit more about CARES Act on that that thing coming up. So each layer incorporates up. Now, what does the AICPA tell us about compliance audits? And this actually works into our audit, our update class, okay? What we are told to do with compliance audits. Now, this is AUC 935, compliance audits. It leverages off the other AUCs, and we're told to establish a compliance materiality. For the most part, the PPC suggestion is that materiality will be about 5% of program awards. Now, that may or may not make a make a lot of sense to HUD. I mean, if I'm sitting with a $5 million mortgage, and I'm going to take a 5% thing, then that's a lot of, materiality that, if I'm talking about, what, $250,000 materiality on compliance, I guarantee you're going to be in a lot more trouble with HUD before you get to materiality. And that's kind of a weird thing. So we'll talk about that. Identify the programs, perform a risk assessment. And that's an interesting concept, because you're thinking to yourself, well, am I not going to look at the HUD audit guide? Doesn't the HUD audit guide just tell me what to do? Doesn't RD's guide tell me what to do? Why would I do risk assessment if I have all these things to do? Well, it's an interesting conversation, and we're going to find out that, there are still required risk assessment procedures, and the audit guide outlines many of them. Then you're going to perform further audit procedures. Now, when you look at this, most of this, it says, does not apply to the financial component of the associated audit. Now, this is the standard statement by the AICPA. And so I do list it there. However, in a multifamily audit, I can tell you that you cannot unwind the financial component and the compliance component separately. There's no way. It's just like they've grown together. The roots are just intertwined tightly. So that's really not going to happen the way we think about it. Hang on a second here. I've got to stop this and restart. I've got just a little problem here with my PowerPoint. I apologize. I had lost a view. Now I just lost it again. If you click on it just the wrong way, I lose my my notes. because I want to see which one is next. Okay. Now our objective is to get enough information to form an opinion. And so when we talk about risk assessment or identifying program requirements, we actually have a tool for a lot of these things. We have a tool. So we have a compliance matrix that we put together. This compliance matrix takes the program types, a 221D4, a D3, these are older, a 236, a nursing home, which is a 232, the refinance vehicles, a 207, 223F, Section 8s, this is capital advance. And then over to the side, we have the HUD audit guide. We identify which requirements in the HUD audit guide apply to which programs. This is risk assessment. So if you have a Section 8 major, non-major Section 8, you have to make a lot of choices about how this works. This is risk assessment process right here alone. Now, to a large extent, you see these uniform guidance listed here. Let me just say this. There are no compliance supplements for an insured mortgage in the compliance supplement. There aren't any. So you're required to come back essentially to the HUD audit guide. And that's what the HUD audit guide is going to tell you. Come back to the guide. And then we're going to be looking at this. Then you have to correlate it to the 12 types of compliance requirements. We've already done that. So each one of the specific tests in the HUD audit guide is correlated to one of the 12 types of compliance requirements. So whether you are, anytime you're auditing a HUD insured mortgage, you are actually going to always follow the HUD audit guide. Okay. Angela, I think she can post a link to that out there. If there's not a link, hang on. Did we have this webinar out there? Oh, HUD 101, yeah, part 1. It's there already, Angela. If you get to the materials, you should see HUD 101, part 1, a compliance matrix. It should be there now. Okay, I think Michelle just posted the direct link. So you're required to determine which of the requirements to test. Now, the HUD audit guide is going to give you some direction there. And then for each program requirement selected for testing, you should perform a risk assessment to determine that. Now, just file that away because we're not going to get to that today, but we're going to, when we get to Chapter 3 of the HUD audit guide in the next session, we're going to go over that very closely. Okay, but let me just say this. There are plenty of risk assessment procedures to perform that are listed straight from the HUD audit guide. And then we determine the further audit procedures. Well, then you're going to tell me, well, isn't it already in the HUD audit guide? And I'm going to say, yes, it's in the HUD audit guide, but you don't know how many sample items you should pull. Sample sizes are dependent on risk calculations. So we have to do that. Okay, then we're going to perform further audit procedures, and this is pretty standard given the HUD audit guide. And then you saw the reporting. As long as you stick to the standard reports, you can't mess that up, unless, of course, you need to qualify or modify the report. But that's beyond HUD 101 day. And then what kind of documentation should you have? Well, you should document the risk assessment procedures performed and a couple of other things of that nature. Of course, the rest is the procedures and materiality. And one last thing that the AICPA tells us, you are only required to audit compliance up through the date of the period. So 12/31 year ends, you are not required to audit compliance in January of the next year. Now, you could theoretically have a discussion about a subsequent event that was so material it affected the prior year financial statements. But for the most part, compliance monitoring ends at that 12/31 date. Okay? Now, government auditing standards. We're going to try to go through here about as quickly as possible. So the concept of government auditing has been around a long time. The government auditing standards are issued by the Government Accountability Office, the GAO. And they are supplemental audit standards for the financial side. If you actually look at the government auditing standards themselves, just look at this is the new version, 2018. They talk about the foundation, general requirements, and then, of course, ethics and independence is a big, big conversation. Continuing education for competency, quality control and peer review. And then if you look for financial audits, there is only, 109 to 16. So 17 pages. 17 pages for financial audits. That's because there's so much of this comes from gas. So they do not give you a bunch of extra things necessarily that, make you unhappy. The independent side makes this a bigger deal, but, and we do have a lot of challenges with regard to independence. Not independence, CPE, but those are pretty well-known things by most people. So that's why we do this. They're leveraging off the financial statements. Now, one thing they do, the generally accepted auditing standards require the auditor to audit for laws and regulations. That's AUC 250. The yellow book just adds another thing on top of that to say, well, we're going to look for laws, regulations, and we're going to add contracts and agreements to make sure we're getting all the grant agreements involved in this discussion. So could the financial statements be misstated from any law, regulation, contract, or agreement? That's a big deal for us to get into the yellow book. So we have to report on that. And of course, we incorporate by reference all the fieldwork and reporting standards. Now, let's just talk a little bit about ethical principles. The requirement here is really only slightly higher than you would normally find in the AICPA. But once the yellow book sets this tone, not following the yellow book becomes an act discreditable under the under the code of conduct. And that's why this gets to be a bigger deal than following our own audit standards. So we're expected to be ethical in how we produce that, and I don't think there's any challenge with regard to most CPAs. CPAs are really well suited to this environment in general. And I think you get the rest of those ethical principles, but remember this. You have joined a profession where you have decided to serve 3 masters. And this is different when you come into the government side. Typically, when you issue a financial statement, in a smaller firm, it might be due to the fact that there's a bank requirement or something. So there's a user. There's a user of the financial statements. So you have to keep yourself happy. You don't mess yourself up professionally and get paid, all those things. The client has to stay happy. And then the users of the financial statements are the third party. In this case, that user is a very, very, very hungry governmental entity. It can't get enough data about any of this. So you are really in a profession that constantly strives to juggle the demands of keeping the three beasts fed. The firm has to keep its side, its interest covered, the client's interests are covered, and we are also counting on the third party for that. And this is the juggling event or juggling act in compliance auditing. This is extremely critical for auditors to understand when we begin in this area. So there are lots of pressures to do things that maybe you shouldn't, and most CPAs resist that extremely well, based on my experience. We do not ever take chances on how we would look at this. And so I like just how this is described because, look, maintaining objectivity includes a continuing assessment of the relationships with entities and other stakeholders. The older I get or the more experienced I end up with other things, the more I realize how true that statement is. And so when you look at this, you're looking at a finding. And you're asking yourself, okay, technically this is wrong, but is it wrong at enough level to actually be a significant item to the government? Or am I going to damage the client more by this absolute incursion of oversight that the client doesn't really need for an item that I consider to be less than material? And so you're always juggling these competing theories and making the correct, hopefully what is the correct decision in every case. Now, independence. Look, the main challenge here, and I'm just monitoring my time, because we are now coming up on minute 82. So we're down to another 20 minutes here, essentially, before the break. All audit work should be independent and we should remain objective and impartial. That's fine. I don't think there's any auditor here that doesn't understand the basic independence rules. Our problem is it's this independence of appearance. Okay, that is the challenge we're dealing with right now. What does it appear to others? Now, the Yellow Book hands out a little bit of guidance on this. And just like the Code of Conduct, they ask us to implement a conceptual framework for making these decisions. Now, they do a couple of things that you see here. Guidance on independence for structurally oriented, like OIG. So you're inside the government. You belong to the same entity you're auditing. I could be internal audit. We don't see a lot of that, but in multifamily housing. The bigger problem right now is just about non-audit services. That's our challenge. In fact, the Yellow Book lists 3 safeguard categories now. I guess this slide is not my main slide. Work environment by the profession or legislation of the firm. So I've listed it out here. There are 3 safeguard categories. That's kind of weird. I guess I had one old slide and one new slide. Now, nobody really addresses this because in terms of safeguards, this is mostly filled out by people coming down to CX 1.2, a PPC thing. Hang on, I've got one filled out here somewhere. This is a little older. So let me get down to CX 1.2. Okay. So list any threats to independence. Talk about your non-audit, non-attest services. Are you going, what are those non-audit services? And they're going to have a conversation about their SKE. The problem with most independents is this form, okay? This is the problem, because when you get to safeguards, they don't prompt you with any of this material. So we're going to look at that a little differently. Now, the yellow book, just like the code of conduct, lists circumstances that cause or give rise to each threat. So most of the threats we see today are typically self-review threats generated in the middle here, okay? From non-audit services, we do see familiarity threat all the time, and the next threat would be management participation, doing things for the client. This is the crux of the matter and how we get to look at independence. Now, the client has to be able to do all these things on their own. And of course, the client is responsible for assigning somebody with the appropriate skills, knowledge, and expertise. We call that the SKE. Okay, and I don't think maybe I say that later here. We call it the SKE, S-K-E, skills, knowledge, experience. But they are not required to possess a specific skill or to re-perform the service in reality. Nathan, there will not be a poll for attendance during the break. We go on the break. So there might be a poll just before the break or at the start of the next after the break, but there will be no poll during the break. Okay, you are expected to walk away. Nathan, walk away. Nathaniel, walk away. And we will be walking away too, generally. Depends on how much fluid everybody has consumed. I'm sorry, it's probably inappropriate. Now, preparing non-attest services. This audit is filled with non-attest services. Every multifamily audit on the planet is going to be filled with non-attest services. So when you look at this, they're telling us that they have threats. And I don't know of a comparable business in auditing where there are so many entities with so many non-audit services that are under such restrictive guidelines as the Yellow Book. So there are some things that automatically impair us, and there are other things which are significant by their definition, and then there are other threats. What are the threats that are automatic impairments? Well, preparing journal entries, account coding, classifying transactions. I don't think we prepare source documents very much, but depreciation schedules, I would think 98% of all depreciation schedules are generated by the firm, the audit firm, because they're doing the tax software. If we do these particular things, then we must show management's approval to be able to proceed. If you can't get management's approval, then you are impaired. Now, the move today is to get all wigged out about the fact that preparing the financial statements is a significant threat. It's automatically determined to be a significant threat. I had an email yesterday from somebody who was on the update course. And what the email said was, my peer reviewer, I'm a sole practitioner, and my peer reviewer told me that I probably now, because it's automatically a significant threat, the only thing I can do is to perform an EQCR on every audit engagement. And I'm going, whoa, geez, that, have an independent party come in and do 5 EQCRs on 5 multifamily projects. Why are you doing the audit at all? You can't make any money on it. And I think that's just absurd. And I was telling the ladies my whole evening last night, I was running through the song in my brain, I'm drunk on a plane, Guy's wife, fiance abandons him before he gets married. He flies to Cancun with her stuff, or with her picture in the seat, and he's drinking all the time. He's drunk on a plane. And all I could think of in my mind was, we've gone independence insane. If you ever know the lyrics to that song, you could probably sing it. We're independent. I'm independence insane. And that was just driven home to me again yesterday. We are way over assessing our risk with this, but there's a very specific model. Okay, Susan, speaking of making money, what is a normal HUD audit fee? Susan, let me tell you this. We did a summary a couple of years ago. We did some analytical review of the business. We're probably going to have to do it again next year. Although we have to get to a year where busy season actually stops. Like this year, busy season has never stopped. And what we found out is this. The best paying audit is the easiest audit. It's not even close because it's a for-profit entity with no subsidy. Those fees can go anywhere from 8 to 12 on average. Of course, the size matters a little bit. The worst audit to do is a single audit. Those would be 6,000 to 8,000. Has a general rule. And guess what? They haven't gone up or down a lot. In fact, if anything, the fees, we keep trying to undercut each other all the time. So I see fees cheaper, I see fees better. But the average multifamily for an average size audit would be somewhere between 8 to 9 to 12. However, if I saw somebody that had 50 of them at one management company, I can be guessing that average might be down to 6 to 7,500. That's what the data would show us. Now, I'm not saying that's good. For most part, it's bad because it's too competitive to get too high. But now we see plenty above that. Trust me, it's hard to put these numbers together. But if you're just asking in general, of course, East Coast, both left coasts, the fees are higher. If you're in Oklahoma, the fees are going to be lower. I've seen rural development audits for $3,000 a pop. Okay, but the average, that you can't make much money unless you're doing a ton of them at that level. And the problem with the HUD audit guide is certain testing is required to be done individually on every project. You can't group project-based test most of this. So that information is actually on our website somewhere. If you look at the previous analytical review, it's a little old, but strangely enough, it hasn't changed a lot. Okay, so management's approval is a big deal on these non-audit services. Now, of course, preparing the financial statements is a significant threat. And we have to go out and apply safeguards. Now, what are we going to talk about for most of this? Now, I do not have my current, Michelle, she's producing this webinar in there. She's actually working on a new template for independence. And I'm going to actually show the chart here because we can't really talk about independence too much more here. But, oh, what did I do with that? I didn't close it. Did I close the dang yellow book? Oh. I wanted to get to a spreadsheet. Well, it's a flow chart actually inside that, but now I can't even see the thing. Okay, so if we get to independence, let's go down here. I had a comment the other day on independence, and I usually have this only in the update course, but I'm going to show you this today. Whoops, get that out of the way. Here's an email we received. Unfortunately, I haven't attended your update yet. I'm sure it'll be addressed, but I need to get your input now. How about new independence rules? Our understanding of the preparation of the statements is now considered an automatic significant threat and that safeguards must be applied. That is all true, okay? And the yellow book lists an example of 4 kind of safeguards. And the auditor asks, how can we realistically apply and document this? I'm assuming most firm safeguards would fall under A or B because I don't see C or D happening. You're not inviting another audit organization into this. And I doubt you're going to do A. So from my perspective, I think what people do is B. And then she was told that I already have received a call from somebody with 5 HUD properties, and we've prepared the financial statement, well, the firm has prepared the financial statements, and now they've told them that they can't do their audits anymore because of the new independence rules. And what should you do? Well, I'm stunned by this, by the way. I mean, this is beyond belief. And I want everybody to just understand this. They've added a new flow chart to this. And this is part of the yellow book. Is the non-audit service preparing the financial statements in their entirety from a client-prepared trial balance? Yes. What does it say? It says identify and apply safeguards. It doesn't tell you to give up the work. It doesn't tell you that you're impaired. So this is a big deal to us in multifamily housing. There are so many non-audit services that go along with this that we are always struggling to deal with the outcome or the consequences of this. But there is no reason for multifamily housing to drop out of that. I mean, for us to look at this and say we can't meet the requirements. So look at the number of non-audit services we would see: preparing the statements, journal entries, tax returns, doing the REACT submission, the corrective action plan, depreciation schedules, working on the cash flow. Look, there's all kinds of things people can identify here. And you have to apply safeguards. And what are we trying to do to help you with that? We're trying to give you a list of the safeguards. The AICPA in the Code of Professional Ethics or Code of Conduct lists safeguards, a ton of them. I've highlighted the ones in yellow that I think most firms do. So this should be a pretty significant thing to get over that requirement. So we make those available to you. Those can all be, that template can be added to this process. Okay, so those are significant threats. You have to assess and then apply safeguards and determine when it's down. So we see a lot of this. This is, if you want to know the biggest issue in multifamily housing, it's independence, it's the non-audit services. That is by far the biggest issue, other than maybe a couple of other things related to the CARES Act. Okay, this is really the single biggest risk factor in an audit right now, and it takes a lot of judgment to get to it. And competence in CPE we'll address when we come back. And we're going to do that really fast, and we'll be done with some of this overall stuff. So I've got us at 11:40. And Yvette, I'm going to make sure that both of those things I just showed, as soon as I start the break here, I don't think that the spreadsheet is in there and a list of safeguards. They're in our update course, but I'll move them down to this material too, so you have those there. So I'll tell you what, we're going to take I think given it's 11:40, I think it's good to start at the top of the hour. We're going to take 20 minutes off right here, and we'll be back at 12 o'clock Mountain. So that would be 2 o'clock Eastern, 1 o'clock Central, 11 o'clock Pacific, and heaven help you if you're still in Hawaii. But we'll be back in 20 minutes, and we'll see you then. Well, everybody, my alarm clock says it's 12 o'clock at noon Mountain Time. That 20 minutes is the fastest 20 minutes I've ever experienced. Went by pretty fast. And I do have one question hanging out about asset additions requiring a disclosure of the details. Do I have an example of that? Yeah, they're in the financial statements. If we go back to the class sample financial statements. Making sure I'm on here. Nobody's telling me I'm not on. So when we get up to the schedule of fixed assets, each addition here would have a detail line on it. So if you're looking at this 1420, 1440, 1460, when you get down to our list of details, here you go. Our addition to buildings, building remodels, smoke detectors, security systems, 1440, dishwashers, air conditioners, stoves, refrigerators, additions to furnishings. Of course, if you had deletions, you would be required to say the same thing. I think that is just the same as all other details. So we're just listing all the details out in a place. This is by far the most common method we would see to deal with it. Other people might put it right on the page, and they would say, look, details for 1420, they list it, and they may put it in different boxes or something right on the same page of the schedule. If you're embedding Excel, then it can be a little more compact. Of course, I can get it more compact here. It just depends on how you want it to look, what your goals are for presentation. So that's where we would get that. I don't know why that screen went away. So if there's a better answer that you're looking for there, let me know. But that's where we would see it. It would be in the same place as all other details. Now, CPE, we're going to do this really quick because there's not much need to languish here. We must assign auditors who are competent. The general rule is that auditors who plan, direct, and perform engagement procedures for or report on a Yellow Book engagement should develop and maintain their professional competency by completing at least 80 hours of CPE in every 2-year period. Sorry to read that. The 24 hours is subject matter directly related to the government environment, and the other 56 is things that enhance your expertise, and that generally includes everything except tax preparation. Now, if all you do is engagement procedures, or you charge less than 20% of your time annually to Yellow Book, then you may only have to complete the 24-hour requirement. That's paragraph 4.25. And of course, if you are a non-supervisory auditor, so you're just performing field work, and you charge less than 40 hours of your time annually to Yellow Book engagements, then you can be excused from any Yellow Book education at all. Now, there is a lot of effort the firm goes into providing documentation to the various oversight agencies, including the Yellow Book, for peer review, the state agencies for licensing. Some of those agencies are on a 3-year cycle. Yellow Book's on a 2. So there are multiple avenues for doing, things like that. The other conversation that's important is just simply what qualifies. So when you look at technical skills and knowledge for Yellow Book training, you get down here and it would tell us that subject, here we go, for the subject matter categories for the 24-hour requirement may be used to satisfy the additional 56. What kind of things go here? Directly related to government environment, government auditing, or a specific unique environment. And then it will tell you here also SASs. So it's not unusual to have the AI CPA classes on audit standards also qualify as Yellow Book. They are directly related to the government environment, government auditing, or the specific unique environment you have. Could be attestation or SARS. It could actually be FASB items. Okay, there's a lot of things that qualify. Now, whatever the CPE, now when you get our CPE certificate today, it will probably have, I don't know what this one says. It's probably 2 hours of government auditing and 2 hours of government accounting. I don't know for sure. I'd have to go back and look at the certificate. But everything's government. You may get a certificate from somebody else and it just says audit or something like that. But with the audit hours, we're on SASs, what's upcoming, what are we currently dealing with now, could be independence. Those would all qualify for Yellow Book. So don't get too caught up in definitions for this. The Yellow Book is very broad on what it allows. Now, a couple of extra things just for financial audit requirements before we get into some of the HUD material, which is probably why most people are here. We have gone to a 2018 Yellow Book is fully under clarity, so it should and must are the new definitions, and we should really understand that. We require auditors to apply materiality in planning. We've talked about laws, regulations, contracts, and agreements. So paragraph 16, you should extend the AI CPA requirements considering noncompliance with laws and regulations to include consideration of noncompliance with provisions of contracts and grant agreements. Now you may ask, what does that mean in particular, Les? It means this, and I have a couple of other examples from other places. Maybe in Chapter 7, lenders. HUD, they participate in Chapter 7 for HUD's Title II lending. They participate in Chapter 6, Ginnie Mae. Then they also have two other government programs, Fannie and Freddie. Of course, the major program report is discussing whether or not the client complies with the HUD requirements for Title II and Ginnie Mae. But the Yellow Book is covering the other additional requirements for Fannie and Freddie, but at a financial statement level. And that's why we get so much interest in some of that. Okay. Fraud, waste, and abuse is a big topic in the Yellow Book, but it's not for multifamily housing in particular because we don't charge to federal awards. I think, the subsidy is given to the tenants. We even classify that as an exchange transaction because the subsidy is identified to a particular tenant's name. Les Sparks gets $500 of subsidy. So we're not charging to a federal award. The mortgage is not even a federal award other than the idea. It would not necessarily be a federal award if it wasn't defined that way because it had ongoing compliance requirements. We don't charge anything to the mortgage. It's just sitting there. It's a federal award because it's a loan guarantee with ongoing compliance requirements, but we're not charging to it. So we don't really get too much into waste and abuse. Now, findings. We'll talk more about findings when Chapter 1 of the HUD Audit Guide comes up. However, understand that we're given a format here of at least criteria, condition, cause, and effect. And we are told now that when we have a finding on noncompliance, we are to consider the impact of internal control when we develop the cause element of the finding. In other words, did the finding come as a result of a weakness in internal control? That is a new world that did not exist until the 2018 Yellow Book came up. Now, last but not least, as we leave this general kind of background to go into HUD specifically, how do we do in light of compliance audits? How were we seen? How is the profession seen from the government by our effectiveness? Now, this looks like 13 years ago. So who the heck cares about what happened 13 years ago? They performed a study to see how effective we were, and they decided that about only 49% of single audits were deemed to be acceptable. And that's because we didn't meet the standards. Now, this has gone on for a long period of time, and they were supposed to reevaluate the study, but because of funding issues, they have never started another study, which doesn't bother any of us. Everything in our profession today that we're dealing with, independence, DOL, a single audit, even to some extent HUD and RD themselves on the for-profit side, we're dealing with as a result of the single audit quality study. And so there's a lot of pressure on auditors who, the government's outsourced all this work to us. They've outsourced their internal control to us. And that becomes an interesting statement for them to say, how well have we done with regard to our work here? And I still think we're better by far than what they give us credit for. But the profession is under a lot of pressure to show that audit quality is better than what they think it was. Now, that gets us through the general portion of this. Now we're going to play a Kahoot game. I'm supposed to play once in every session, but the breakdown was a little bad. Now, for those of you who have not played Kahoot before, your game is on your screen. We ask you to, it's probably better to play on your phone. So you go to the website, kahoot.it. It's free. You don't have to have the app. Just go online to kahoot.it, and it'll ask you to enter a PIN. And then you're going to enter the PIN that's on the screen. Give yourself a nickname. And we're going to do a review of this. Now there will be 12 questions, 9 of which are technical. Most of this stuff in here is reviewing the material we already covered. So get your phone out and play. The questions will appear on the screen. You will answer on your phone. Certainly, the object of the game is to get a correct answer. But in Kahoot, time, speed is of the essence. So the quicker you answer correctly, the more the points you get for the answer. So you can answer correctly, but 10 seconds later, you'll get 750 points, where if you were 10 seconds faster, you might be 935 points. How many you get in a row is a good thing. If you get 3 or 4 in a row, you get bonuses. Now, with the people we have online today, 125, we're paying top 5, 1 through 5. Less is more. You know, that's the first time we've heard that. Less really is more. Trust me. Lots of fat here. I'm trying to lose it. I'm walking 3 miles, 4 miles a day. And I don't get a McDonald's Coke anymore. That's tragic. So I'm drinking flavored water right now. I guess pineapple bubbly. That's not great. Okay, we're not going to get to 100, but here we go. Looking for interesting names, by the way. We're always looking for humorous names. Oh, I'm not scrolling. I can't tell what the problem is. And I don't like this music. Oh, we're at 98. We're going to start. Here we go. We don't have all day. Question 1. Which layer is the base layer for HUD audits? The very basic. What is the start of all HUD audits? The answers are coming in fast and furious. Gas! Woohoo! 51 of us. Now that doesn't speak much for instructor effectiveness, does it? Only half of us got that. I guess I'm pathetic. I'm sorry. I've let you down somehow. I don't know. The Kahoot games can be a little hard, but Abby, Panda, Rona, Lisa, SPD, and CP, and you're only 8 points apart. In fact, Abby and Panda, that's got to be a very small statistical value to get that together. The odds of that are small. True or false, AUC 935 does not require a test of controls if controls are ineffective. Remember, this is controls over compliance. Unfortunately, we know you're here, but this doesn't count as one of the attendance things. But we know you're here. Okay, that is a true statement. You are required to test internal control over compliance in all cases, unless it is ineffective. What are you then required to do? Report the findings. So I didn't make that clear. This was complete instructor disaster here. This is a result of my own inadequacy. So the true statement, you are not required to test internal control if you've already assessed it as ineffective, but you must report the finding. Goku, JSB, Kim, Katie, and HUDman. Well, if you're going to take the HUDman moniker, you better be on the leaderboard, hadn't you? So how does it work for question 3? Which of the following things are auditors not allowed to report? Now, I didn't cover this. This is a general theory question. I'm not sure if I'm covering this out of order. Okay. Now, auditors are allowed to say in our report, and we do say it, there were no material weaknesses. We are certainly required to note material noncompliance. We are also required to report non-material noncompliance. However, we are never, ever allowed in any area of the audit profession, this is not just a compliance thing, to report that there were no significant deficiencies. Yeah, well, Brianne, I don't think it was the way the question was phrased. I think I didn't tell you that. This one here is just something we're supposed to know. Now, it's in basic audit standards all on the way. It's just that we don't usually report it very often there until we get to the yellow book. But one thing we cannot say is there are no significant deficiencies. JMO with the lead. Oh no, Goku, JSB, and Kim. Woohoo! I think we're at trivia. I don't know what trivia is. What are the only two games where men and women compete together in the Olympics? There might be two possible answers here. 50-50 guess. Sailing and equestrian are the only integrated sports, I guess, huh? Sexually integrated, gender integrated, I don't know. Oh no, oh no, you're up. We have a new, everybody change positions. Kim, JSB, Laura, and Hudman is still up there. And we've brought the group closer together. The auditors need to detect non-compliance goes through what? Year end, report date, year end, all times, all preceding periods. I did very clearly try to say this. Year end, not through the report date, but through year end. That's why we like AUC 935 a lot, because it tells it's very clear about that. Oh no, Kim, you stayed in first and second. HUD came up from fifth to third, SPD and JMO. And here comes Sarge up 34 places. Wow. That's a lot of heads to step on as you come over the group. Auditors should report non-compliance with laws, regulations, contracts, and agreements. When? This is a yellow book requirement. Yellow book focus is on what? As opposed to the HUD focus. Now, in theory, some of you who answered green, there is a little bit of truth maybe to what you listed there, simply because we are required now under the new yellow book to report non-material non-compliance also. However, the purpose of the yellow book is to detect non-compliance with laws, regulations, contracts, and agreements in the context of the financial statement. So when they're material to the financial statements, the yellow book focus is always at the financial statements and not the major program. HUD, RD, single audit gets you focused back on the major program, but you end up having materiality at the financial statement level to detect non-compliance for LR, laws, regulations, contracts, and agreements. Oh no, stayed up. Buckkeeper came closer. Buckkeeper. I'm going to keep a couple of my bucks today. These are all Amazon gift cards, so they should spend freely. No filthy COVID cash. What do you think is the biggest threat to auditor independence? The threats themselves. We would say it's probably related to the preparation of financial statements or the non-audit services. Which threat do they create? That would probably almost always be a self-review threat. That's why we're looking for independent reviewers to come into play here. That would be the threat, self-review. That's a kind of a hard question because unless you do it a lot, we're just trying to reinforce a couple of ideas in the game. So, oh no, Buckkeeper came up. SPD 1, 2, 3, 4C and Kim 900 points of about. True or false? Most cities who host the Olympics gain a profit because of surge of visitors. True or false? We were supposed to see the Olympics this year when we saw this 2020 quiz. So COVID kind of killed the Olympics, but the Kahoot game still has Olympics in it. The great postponing of everything in life for another year. That is false. Most cities lose a boatload of money. I don't remember how Salt Lake fared back in 20 years ago, but anyway, 18 years ago. Oh no, SPD 1234C Lara HUD man. We're still about 900 points from 1 to 5. Remember, paying top 5. An auditor is not required to obtain Yellow Book CP if and only performs procedures. They don't supervise or anything else. One group is okay. And never has to meet the requirements, but only one group. Yes! Look at that number of 55 people up there. Oh, I feel so much better about myself right now. Oh. Sometimes the stress of these games gets to me. Oh no, SPD Lara, Buckkeeper, 1234C. Oop, we've almost eked out to just over 1,000 points from 1 to 5, but 10 players are 3 in a row. Streaks. So bonuses are big. Yellow Book compliance reporting requirements extend to what? All of the above. So Yellow Book requires non-compliance reporting for any of those areas. All of 55 of us, man, it just makes an instructor so happy. SPD, oh no, Buckkeeper Lara, 1234C. And now we have a tighter grouping. We're getting down to the last few questions, 2 more to go. Findings for non-compliance should include which of the following? This is a little bit of a trick. There are multiple correct answers here, so don't wait too long. If you answered, you got a point. The trick to this question was simply making you hesitate to pick which one you really wanted to go with, because they're all required. Now we've got a close race. We're down to probably an Olympic question. I do not know what the next 5 or 10 look like on down the list. We don't get to see those. But 3 players just hit 4 in a row, so anyone can be overtaken here. SPD, if you miss this, or Buckkeeper, you can be passed by several people. We could have a complete revolution on the last question. Which were the first Olympics to be televised in the United States? I do not know the answer to this. (1960) Summer Olympics, Rome. Okay. That was not the preponderance of the evidence, but how did it turn out? SPD! Speed! Way to go! Number 3! Lara! Buckkeeper got to first. Who's 4th and 5th? Oh no, and Katie. Look, we had a pretty big revolution up there on the top 5. If you are in the top 5, Michelle's already got the question out there for you in the chat. Email Kathy at ahacpa.org. We hand out the gift cards at the end of class. We'll have one more game to go. I appreciate you participating. It gives us a review. It's something else to do. So just email Kathy your screen name, whether you placed first, second, third, fourth, or fifth. And that's all you need to do. We appreciate it. Thank you for participating. It's important to us as a CPE provider. We are trying to give you ways to encourage participation. So it's really, when you go online, it's a lot harder. You have the chat, you have the Q&A. We also reach out with the Kahoot and try to prove, look, we had 100 people playing Kahoot when we had 130 or so registered for the class. So we're giving opportunities, and there are even technical questions. So 120 people, I guess. Okay, now on to some other stuff. Now this always bleeds over a little bit into the next day, but we'll get through some basic things. So what kind of thing is, what does this mean for HUD? What are the operating concepts? What does REACT do? When those financial statements hit REACT, what's going to happen? Okay. What will we see? And what are the other issues with regard to this? So what HUD itself, this is what you see when this is the outside facing part of HUD. Now there are about this many more departments. Maybe that's the best way to say that. There are that many more departments that are only internally focused. Now, we start public housing or housing way before there's HUD. HUD is a 1960s, creation of the federal government during Lyndon B. Johnson. So when you look at it, it does a lot of things, but before there was actually HUD, there were programs. And so, and those programs are probably related more to public housing or to just housing. So when you get to that point, you are looking for, what really happens in these entities. But HUD itself is a cabinet level agency. It was a product of the Great Society in the 60s. And this is what you see organized now. Now we're going to be focused today on housing. We do a lot of public housing. Now public housing or housing in generally starts even before the National Housing Act. So when you get into the Depression, 1930s, 34, 33, you end up with, stimulus, I guess is the best way to say it. Now, the Depression is kind of a different world than, say, COVID. For COVID, I mean, just think about this, I guess, in light of what we know today about everything. We create a bunch of agencies that still last, 90 years later. We're still dealing with these agencies that we created. This time when we had this huge meltdown, we handed out $2 trillion, and most of it we just handed out through the current agencies we have. The last time we had a big disaster, 9/11, something similar, we created a whole new agency again. We called it Department of Homeland Security. So tragedies can bring out these new agencies, and the Depression was the one that created really the genesis of HUD. So people are worried about housing. What's the main topic of the day? The main topic of the day is housing. It's immigration. And so you have all these immigrants flooding in from Europe. You have the Italians. You have the Irish. You have other European immigrants coming in, and they're not very, it's a lot of discrimination. And the housing's bad in those big cities. You have tenements and it's really slumlord vision. Well, people get interested in improving the lot of the poor, and we start getting housing programs. And then by 1930 something, the government comes along and establishes the National Housing Act, or 1933 and 34. There are pieces of each of those times. And we start to put structure around this. And of course, somewhere in the next 15 to 20 years, we start to build public housing projects with government money and ran by the federal government. These ultimately turn into what anyone who grew up in the 70s knows as the projects. So even in the 60s and 70s, we would have the projects. So if you're really looking at HUD, didn't come along until what, 1964 or 65. We had projects before then. And then we realized that the government really, what's the right word here? I'm just going to say it in a crass way. The government sucks at running housing. So they move those housing authorities out to cities or counties, and they appoint local boards, and they control the assets, and that's becoming public housing now. Public housing is two programs primarily. That is the operating fund, which runs the public housing projects, the things you call the projects. Then there's a voucher program, which is a tenant-based Section 8 system, and that allows, the goal of that program is to make sure the people on subsidy don't all live in the same building. They can take a voucher and live wherever the landlord will take a voucher. So they're integrated more into the community. That's the idea of this. Now, at the same time, we create housing, and housing is really, to me, one of the greatest things that ever happened in government, okay? And we'll show why in just a second. Now, to round this out, you have entities that hand out money through faith-based partnerships. It's not a lot of money. You have the Inspector General, which is the Internal Audit Department. We have an entire group dedicated to fair housing, and HUD takes fair housing seriously. You know, if you watch the news and you think about things such as systemic racism. Now, whether people are systemically racist, or people are racist or not, this seems to me to be an obvious question, or there's an obvious answer to that. Individuals can be racists. I have to admit that there are people who are racist. But as a system, we have worked very, very hard to avoid systemic racism. And I can tell you, all you have to do is to get a whiff of a misconduct on fair housing, and HUD will be on top of you like, I don't know what. It'll be a ton of weight. It will be unbearable weight. So we take fair housing very seriously, and all allegations of any kind of discrimination in the housing market is really looked upon heavily, as a bad thing. Now, CPD is where the majority of the money goes. CDBG grants, all the big block grants. So the majority of the money handed out from HUD is actually handed out in these block grants, and they give them to cities, counties, states even at some point in time, who then are really pass-through entities and hand out more money to the constituent groups below. Now, Ginnie Mae is actually associated with housing in that it takes mortgages generated by FHA and repackages them as investment vehicles. So we do participate with HUD insured mortgages in the secondary market for mortgage insurance or mortgage investment instruments. Enforcement is what it sounds like. That's a new agency. That's the newest part of this department. Not a new agency, but a new department. And it came about when REAC was instituted, and its goal is to ensure compliance. Now, DEC's primary compliance methodology is the assessment of civil money penalties. When owner of a multi-housing project will not comply with the terms of their regulatory agreement, they have several tools available to them. The most common and by far the most used, I mean, and the most impactful, frankly, is the imposition of a civil money penalty. Now, civil money penalties change each year. In fact, I was looking this up yesterday for another conversation with somebody. And if you look at the Federal Register for this year, I thought this was just interesting to show, because people always wonder, what's the big deal? Why does somebody like Les talk so much about non-compliance and each of these things? Well, look at this. And this is done all the time. If you make false claims, that's a 11,600. Disclosure of advanced disclosure of funding. I don't know what that means. FHA mortgages and lender violations. That's 10,000 per occurrence. Look at multifamily and Section 202-811 violations. $51,222 is where the civil money penalties start. Now, let me tell you how this works. Let's say you have a requirement to file within 90 days, the financial statements after year end. You do not file within 90 days. HUD will send you a letter saying you have not, after the expiration of 10 days. They give you a 10-day grace period. Then they will send you a notice, and we'll talk about all this in just a minute. They send you a 30-day letter. At the expiration of that 30-day letter, they technically have the ability to assess civil money penalties on you. And if they assess civil money penalties, that assessment will be $51,222. Now, the client may not pay that, but the client's going to pay between 5 and 10. I've seen some where they only negotiated down to half. So compliance is a big deal, and owners don't all recognize that. And so HUD wants to keep that going. Those are all assessed by this DEC group. Now we move over to housing, and this is where I think that where we're going to spend all of our time. The majority of our effort here focuses on FHA. And FHA really, I should split this out a little bit. FHA creates both the mortgages for multifamily and single family. And they also create the mortgages for the Office of Healthcare Programs. That could be a nursing home, assisted living facility, or a hospital. Now, the beauty of most of that is that the government's never actually incurred, there's only been one. There has been one appropriation in the time FHA's been in existence. That time was simply in 2008-9. FHA was really low on liquidity and couldn't meet the liquidity standards, and so the government put about $1.5 billion or something into FHA. It was repaid within less than 2 or 3 months, and that's the only time Congress has actually approved money for the FHA. Otherwise, FHA is an insurance company that lives and administers the program based on insurance payments, mortgage insurance premium payments from the borrowers, be they single family or be they multifamily. And so we're actually auditing the loan risk for FHA. That's what a multifamily auditor is doing in most cases. They're auditing the mortgage balance so that, not the mortgage balance per se, you are doing that, but you're auditing the state of the mortgage so that the building represents valid collateral for the loan. Okay? Then multifamily also hands out Section 8 assistance. But outside of those two assistance areas, there is no other money appropriate. I would say an appropriation. Congress does not have to prepare an appropriation for HUD related to the mortgages because it lives off the loan fees. So we're just essentially auditing the controls over the insurance program. Now, HUD does collect the financial statements and they do assess those. And that's the basis for their assessment are our financial statements. And then we also include an assessment based on our work of their compliance, but HUD does their own review. So HUD does insured mortgages. And what did I say earlier? All insured mortgages, whether they're for-profit or nonprofit, have to follow the HUD audit guide. Where we actually expend money, these are all nonprofits, and it's mostly the place where 202 loans were handed out and they're serviced from HUD. Very few of those left. And the other is we handed out a capital advance, which means you take the money, you build a building, you run it for 40 years, and you do not have to pay the money back. Those programs are also associated with subsidy in the form of a PRAC, a Project Rental Assistance Contract. So we would have insured mortgages, we have actual expenditure mortgages, 202-811, and then we have subsidy. And that might come in several different flavors. And that's what we're dealing with here. Now, when we look at a loan, the loan itself is governed by a regulatory agreement. Now, that regulatory agreement will extend up to 34 pages long, and it depends on which one you have, how you view the world. I'm looking to see which one I have in here. Okay, this is the most recent. Well, it's not the most recent. It's a newer one. There is a 2018 one. This is the regulatory agreement. There are multiple flavors, though. This one is, you can see it down here because it's listed in 92466M, dated 6/14. There are some dated 11. And there's now one dated 2018, and there are some dated in 2022. 2002. How did I get down to that level? Now, one of the biggest changes in regulatory agreements is this idea of the residual receipts. In some programs, HUD had requirements that were written into the legislation that developed the program rules. And those projects were limited into how many dividends the owner could take. Now, some said they couldn't take any. And that meant if you had extra money left over at the end of the year, you had surplus cash, you had to put that surplus cash into a residual receipts account. And then HUD controlled it. It's actually project money, but HUD would control whether it was spent or not, and they were very stingy about that. So an example of residual receipts. Let's just say that I have a HAP contract, and I think the HAP contract I have in your materials does this. In the material I've listed, there is the HAP contract. And this is the HAP contract I'm showing. When you get down into the details, financial requirements, you get down to B, and it'll say, project funds must be used for the benefit of the project, to make mortgage payments, to pay operating expenses, to make required deposits to the replacement reserve. To the extent HUD determines that project funds are more than needed for these purposes, the surplus cash must be deposited with the mortgagee or other HUD depository, I guess, in an interest-bearing residual receipts account. Now that would just say, if there was any surplus cash, you had to take it and put it into residual receipts. And it meant just what it said. These are receipts HUD gave you, theoretically from subsidy, that you did not spend, and we do not let you take a distribution on that. So you put it in a residual receipts account. Now there are others where you could get a limited dividend. So if you continue down here about use of project funds. So this would be C1, 2, I don't know why this is different. For the nonprofit owners aren't entitled to distribution. So that all your surplus cash would go to residual receipts. And when you have a surplus cash calculation, and I think I have one of these here. This is in your materials also, and it's just opening. If you came up with a positive number here, okay, that's a deficiency obviously, but let's say you had positive number and you could not take a distribution, that would be the number that gets deposited to surplus cash. I mean, to residual receipts. Now, if I'm in this HAP contract, what I can know is that if I'm a profit motivated owner, and then it says, but if I'm an elderly facility, the first year's distribution will be limited to 6% of initial equity, and we may provide for increases in subsequent years. If I'm non-elderly, I can take up to 10% of initial equity. Everything over that would go to residual receipts. Now, as we move into the current world, we're getting less and less and less of that residual receipt because the regulatory agreements are not including residual receipts riders. They're being marked X here in more cases than not. And that decreases our equity skimming risk, by the way. Because if you're going to allow the owner to take out all their surplus cash as a distribution, including nonprofit owners, what's the motivation to take money out of the project? At the worst, it's a tax play. I could get someone to pay for my taxes. So regulatory agreements dictate your behavior. I mean, client behavior. And they dictate your requirements to audit. Now, I'm not going to get into a lot of the details of the agreements, and they're all different. This one's the more current one. You may see some that are that look like this. Multifamily forms, reg agreements. Let's get me an older one. You may see some that look like this. This is a 202 one, but they're in 2 columns. And these are much shorter. This is 4 pages long. Whereas this one is 35 pages long. Now, what's the difference in the evolution of the regulatory agreement? The basics are all the same. Okay, the basics are the same. Pay your mortgage, fund your reserves, calculate surplus cash, whatever. The difference is in the amount of detail they include here, because when you look at a regulatory agreement or you have a list of multifamily stuff, so if I'm to talk about multifamily handbooks, just HUD handbooks. Now, I've got some of these broken into chapters, but look how many handbooks there really are. This is nursing homes, the handbook 4350.1, 4350.3 is the occupancy guide, 4370.2 and 4370.1, 4381.5 is the management agent handbook. I mean, we have 6 or 7 handbooks that are directly apply to multifamily housing. So when you would refer to those. Before you'd said, look, you had to do that, but now they've actually taken text out of those and put it specifically in the agreement. So they define what the borrower is, they define what is attached, the fixtures, what the property consists of, the land, the improvements, the fixtures, the personality, all current and future rights, including air rights, development rights, zoning rights, other similar interests, easements, tenements, right-of-ways, strips, and gores of land. A gore of land is just a piece of land that pokes into another piece of land. Why ever it looks like a sharp thing, so it would be called a gore. If you own a high-rise building and somebody comes along and says, hey, let's put a cell tower on that, the revenue for that project, or the revenue from that cell tower lease, belongs to the project. It does not belong to the owners. Any revenue that can be generated by these buildings standing area as it is belongs to the project, not to the owners. It's part of the mortgaged property. And this is a conceptual thing that is the most important to remember about how we work in the HUD or even the RD multifamily. They're really all the same. Okay, so they get a lot of definitions. Personality. Look at how we define personally. What does that take? 18 lines to define what that is. Now you can see the expansion here. What does it mean to be a program regulation? All applicable statutes and regulations, including all amendments, as they become effective, except that changes subject to rulemaking will only become effective after the completion of the rulemaking process. 2, all current HUD requirements and handbooks, guides, notices, mortgagee letters that apply, and all future changes, updates, amendments there too. So they're very now diligent in assigning the requirements to, you cannot get out of the requirements. They define what operating expenses are going to be, what rents are. Waste is another definition. And then we can skip the construction side of this. That would be more cost certification related. We get to financial management. You'll make all your payments due under the note. Now we're going to get down to essentially what? 1, 2, 3, 4, 5, 6, 7 compliance requirements, main compliance requirements. Pay your mortgage, fund the reserve for replacement, make sure all cash that belongs to the project comes to the project. Anything you spend is for a reasonable and necessary expense, or it's surplus cash. If you collect security deposits, then you must equal or exceed, the balance in the cash account must equal or exceed the liability, maintain the building, and how we calculate management fees. Of course, then we define surplus cash in this process also. Those are all functions of the regulatory agreement. Then you fund the reserve, put it in a separate reserve account. It's escrowed, it's paid with your mortgage. Disbursements have to be approved by HUD. All the rents and other receipts of the project will be put into the project's operating account. You will only withdraw them for reasonable operating expenses. Trust me, HUD takes all of this very seriously. Now, this is the focus of the audit, by the way. Did you pay your mortgage? Yep, that's in the HUD audit guide. Did you get all your cash into the project? Well, we have a cash receipts test. We also have a cash disbursements test. We have a test on calculating distributions. We have a reserve for replacement test in the HUD audit guide. All of these things are designed to get you down to a level where you can determine that the client has complied in non-material respects with the regulatory agreement. Now, the HUD audit guide is a reasonable facsimile of those requirements. Security deposits, they're not even required to be collected, but if you do collect them, then they have to be separated and they have to always equal the liability and the asset. So that's pretty important for us, especially when you then go to, say, the HAP contract, and HAP contracts are very different. Most HAP contracts do not contain the highlighted things you see here. Many HAP contracts are silent with regard to surplus cash. They do not require residual receipts or reserve for replacements. And in fact, many Section 8 contracts don't put any restrictions on the use of project funds. So in theoretically determining what applies, if you don't have a HAP contract that stipulates this, the cash disbursements testing in the HUD audit guide does not apply to you. And the only way to know is to read the agreements. Okay? Now, we're only getting a very brief window into this. But trust me, this is the purpose of the audit, and these are the basic requirements for almost all, well, they are for almost all insured mortgages. Now, there are some differences based on the older mortgages, but that is how this is defined. So most versions talk about running the program, and I said, duh, right? Big surprise. And they require the client to actually verify tenant income on a periodic basis. Well, it's just generally annually. So you calculate rent, you collect the security deposits, maintain the building, and there may be some financial requirements in the one you just saw, like reserve for replacements, or maybe they don't allow distributions. There are a few HAP contracts that actually require you to return money to HUD if you have extra. Now, I don't think this is as current as I wanted it to be. I haven't updated the numbers here. But when you look at this, we're talking about auditing really near $100 billion worth of mortgage insurance for multifamily housing. So how many units of affordable housing are there out there? Probably about 1.2 million of some sort. And this is kind of a summary of the mortgages that you will find on HUD's website on this. Now, how a project gets evaluated, or what's an operating environment is. You'll notice that I do not have money coming into the project, so I'm assuming that tenants are paying their rent. Now, there might be subsidy coming in here, so HUD might be paying their rent. But that money stays in the project. Any source of money that comes as a result of that building belongs to the project. And of course, we build a castle wall around it. That castle wall is a 35-page regulatory agreement. And the people on top of the parapets, or whatever that's called, that's REAC, and they're looking at these financial statements that are submitted annually, electronically, and they're evaluating both the financial statements themselves and your audit work. Did you have findings? Did you have other things about this? And of course, on the drawbridge is the CPA auditor, and I'm sorry, he's too gender specific, where I know most, 60% of the auditors now are probably identifying as female, I guess. I'm kind of scared to say anything about that, but so we just picked that goofy little icon to represent the auditor, so I'm not trying to imply anything else. You are standing on that bridge with the review of saying all the expenses that came out of there are reasonable and necessary expenses. That could mean mortgage payments, escrows. It could be the management agent, the management fees, other expenses the management agent incurs, or vendor payments for whatever the project's incurring. And of course, the owner gets a little surplus cash once or twice a year. All the revenue has to stay in the project. That's the job here. So the basic theory is all the revenue that made it to the project stayed in the project. The expenses were reasonable and necessary expenses of the project, or they were allowed distributions of surplus cash. And this is the picture you're supposed to keep in your mind about how HUD views this. Now, HUD has reviewing things. They've divided this up into multifamily, into separate pieces, and that's hurt the business a lot because they have decreased, if you will, the number of people who know the details about a local project. But it's done. So what are the concepts here? And I think this is pretty similar. Do the expenses appear reasonable? Yes or no? Now the question you're asking yourself, if they have a non-subsidy regular agreement, but a few residents get Section 8 assistance, how does that work? Okay, Susan. Now I assume what you're really describing to me is they have a regulatory agreement that provides for an insured mortgage, but there is no project-based subsidy contract at the client. So what you're describing here is a situation where certain tenants are living in the units receiving a tenant-based subsidy from the housing authority. That's called a voucher. If a tenant lives in your unit that's getting a voucher, has an auditor, we do not care. The voucher is determined by the Public Housing Authority. Any compliance or recertification work for that tenant is handled by the Housing Authority. As far as we're concerned, any voucher payment from the Housing Authority is just simply another check. We are just the landlord, and they're living here, but any compliance-related issues or any compliance issues related to that contract reside at the Housing Authority. So for you to be worried about the compliance at that site, it has to be your client's HAP contract. So plenty of multifamily housing have Section 8 people living in them, even though they do not have a Section 8 project-based contract. So that would be a tenant-based contract where the tenants take the money, they live wherever they can get someone to take the check. And we are out of the woods on those. So the only time we worry is if we have a project-based HAP contract that is administered or ran by the tax ID number of the project that we audit. Okay, so the client has to have their own HAP contract. Now this cost about what's reasonable is not about what a comparison is. It's about what a normal frontline cost is defined to be by HUD. And there is a handbook that does that. Okay, that's handbook 4381.5, sorry. So reasonableness there is based on a definition already given in a handbook. Now remember, we keep the owner separate from the project. The owner may also be the management agent, so they have a related party relationship there at the same time. Okay? And so that might increase, that we would call, HUD would call that an IOI. And that's how that would be handled. We would just know them as related parties, RPTs, related party transactions. HUD calls them IOIs, identities of interest. So if that's happening, and then we also have a difference between entity cash and project cash. Now, if we're looking at our financial template, the accounts, we have an operating cash account, and then we have a construction cash account. Then we have a place for an entity cash account. Entity cash is cash that came out of the project through surplus cash or another manner, where the cash was defined to not be part of the project. This is an interesting concept to deal with. Let's say I had a calculation of surplus cash. And let's say this is a positive $20,000 or $19,000. I decide based on a couple of criteria that the management agent might know they need the money or something like that. And they're not going to distribute it. They might take that positive $19,000 and put it into entity cash. That means the project had surplus cash. The owner entity has earned the right to possess that cash, but they have not distributed the cash. It's still sitting at the project. The chart of accounts is full of these entity-related things. When you get down to the 7,000 accounts, these would all be entity expenses, something that could not be chargeable to the project and was paid at this level, but was determined to be coming from already established surplus cash. Now, this is a concept that's a little harder to grasp. So there is almost all cash belongs to the project, but there are relatively few instances, such as surplus cash earned that was not distributed, or maybe refinancing proceeds that were not defined to be part of the project. Now, most entity cash is removed from the project, but when it's not, we can recover. It sits on the balance sheet, and asset management fees, Susan, always fall under entity expenses. When you look at the definition here, 7190, asset management fees would typically be shown here. Asset management, you see it right there. Asset management and similar fees always, always, always come from surplus cash. It doesn't matter what the partnership agreement says about it. Now, Kimberly, you're asking, is the project required to keep entity cash separate? Technically, I believe the answer to that is yes, but there is no established requirement for an entity cash account. So I think we would not mind having cash in the same account, as long as in the same bank account, as long as we know how to separate out the entity cash from the operating cash. So I can't tell you there's a specific requirement for it to be in a separately owned bank account, but it is separated all the time in the chart of accounts. But you won't find a requirement to keep entity cash in a completely separate bank account. Now, maybe that's just because it was implied and people should know, but as a concept, if the following year surplus goes negative, does that eat against any entity cash? No. Each cash calculation, surplus cash calculation, stands on its own. So when you calculate surplus cash and you get to a negative amount, as long as the calculations were done in prior years correctly and in good faith, there is no going back and recovering that. Now let's assume for a second, Brandon, that you had a mid-year calculation and a year-end calculation. So at the mid-year calculation, you showed $20,000 of surplus cash, and in July, they took it. But by December, something else has changed, costs went up or something like that, and there is no surplus cash. In fact, it's $20,000 negative. You still have the ability to take the $20,000 that was issued in that first 6-month period. Even inside the same year, it does not go negative. So the regulatory agreement's clear on that. Whatever you earned in good faith, unless HUD can prove you didn't calculate correctly, then there would be no recapture of that. So you can have a mid-year calculation that's positive and they took the money, and an end-of-year calculation that says it's negative, and all that really means is you cannot take any surplus cash out in the next year or in the next 6 months until you get to the mid-year calculation. I appreciate the questions. These are all really, really basic understanding things that auditors have to come to grips with in HUD 101. In fact, it might be more HUD 201, I don't know. But this is having that understanding, okay? Now, Susan, you said seems like some projects deduct principal from the mortgage payment and some don't. You are absolutely correct, and I do not mind on extending this conversation here. In the regulatory agreement in 2014, you get a definition of surplus cash. Now, it's not really as beneficial as you want it to be, but in terms of clarity, but here's what it means. Surplus cash is the equal of all the project cash, cash equivalents, excluding the reserve for replacement account. It includes short-term investments, HAP payments receivable, plus any amounts withdrawn, approved for withdrawal, but not yet withdrawn from the reserve for replacement. So you might have already spent the money, but HUD's approved the withdrawal, but you don't have the money yet. Then you deduct out all sums due or required to be paid within the calendar month following the date. Now that is typically payables within the next 30 days. And then they add here, without limitation, principal, interest, mortgage insurance, MIP, right? And deposits to the reserve for replacements, as well as escrows. Okay, so Susan, here's the story. Certain regulatory agreements beginning in 2011 have one requirement, where 2014 have another requirement, and regulatory agreements before that only have interest. Now, I think there is a slide coming up about this. Maybe I don't have it in here, I don't know, where we kind of summarize that requirement. In fact, maybe what I should do, I'll tell you what I'll do. I will add, I have another slide that does this. I will post it into the material, and we will discuss it at the next part 2 class. So Michelle, if you'll make me a note, then we'll deal with that. And that's important, and we will have the time in the next class to do that. So the regulatory agreements vary, and so you have to read them. If you're in, say, the regulatory agreement for a 2011, and I'm looking for the 2011 version right now. Okay, now here's the older one. We'll skip the first page on the closing instructions to the attorney and get actually down into this one. Surplus cash. Oh, come on, Les. You know, I get nervous here and I just can't find what I want, even though I know where this is. Okay, 6E, right? So we wanted to go back up to 6E. Okay, make or retain any distribution of assets except for surplus cash and on the following conditions. All distributions shall be made at the end of the semi-annual annual period. No distribution would be done that way. Any distribution of funds, that wasn't the actual definition I wanted. Oh, there we go. Okay, it was down lower. Surplus cash means all sums currently due or required to be paid under the terms of the mortgage. Now, that is not referring to the mortgage payments in the next month. What you're currently due and payable under the mortgage at the end of one period is interest that is required to be paid in the next month, because interest is in arrears, but the principal balances are all due for January. And so that one only required interest on the mortgage, plus payables that were due within 30 days, and any other. So it's very, and I think there are other slides coming up here that define this a little better. Maybe it's in the second part of the class. So 2011, okay, here's 2002. We required payables plus only interest. 2011, we required that to be included. Here's the 11 one. Let me just hurry and get to there quickly. They're going to define surplus cash here. And they said payable due under the note or to be paid under the terms of the note on the first day of the month following, including without limitation, all amounts required to be posited in the reserve for replacement or other reserves as may be required by HUD. Now, this to me meant the same thing as the 14 one, but they didn't really believe that, so they said they thought it was weak, so it was interest, principal, and reserves in 11. And then in 14, it was the full mortgage payment, Susan, okay? I know this is like really sticking a fire hose out here and turning the water on. So yes, some deduct only interest, some deduct principal, interest, and reserves, and some take the entire first payment, okay? So I'll answer that. Mega, with the mid-year amount, is there any limit that the drawing should be done before? Yeah, you have to be done before the next year. You have to distribute it all before the 12/31 limit, because at 12/31, any cash left in the project then becomes surplus cash again. Now, the only way to avoid that would be to reclassify surplus cash you didn't take as entity cash. But if you leave it in the cash operating cash account, anything you do not take becomes surplus cash again at the next 6-month calculation. Okay, so management fees, we've answered that. That's always, always, always from surplus cash. We don't have a definitive answer for whether the entity should or the project entity cash is separated into a separate bank account, but it is clearly separated in the ledger. So we're done with that. With the mid-year amount, is there any limit that drawings should be done before? Yes, you have to complete those. Any surplus cash not taken, it's either moved to entity cash or it automatically becomes surplus cash to be distributed in the next 6 months in the calculation. That's how the theory works. Okay, if 12/31 surplus cash is positive, can you take that amount during the next year, or do you need to recompute surplus cash at the next 6/30 and be limited to that? Okay, now Paul, here's the thing. This is a great question, theory question. People will want to take the idea and say, okay, I calculated surplus cash at 12/31, and let's say that amount is $20,000. So just get rid of the negative amount, we'll round it to 20. Now, the surplus cash that's available, let me just insert this here as a text box. Okay. So I have surplus cash, and I can't type a darn thing. At 12/31, let's make it 19 this year. And we're going to call it $20,000. Okay, then we distribute. And I'm going to distribute 15,000. And let me just say before. What happened there? Good grief. Before 6/30. Oh, what in the world? Holy mackerel, what did I just do to myself here? Escape, 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 escape. Well, I've screwed everything up now. Now Kathy probably needs to come in and rescue me or something, huh? I don't know why I am dying here. It just goes gray and I can't figure it out. Okay, so let me just delete this whole thing and start over. Okay. It won't do that. It's not wanting me to put text in there. Okay, so you distribute 15,000. So let's think about it like that. Now, theoretically, you have $5,000 of surplus cash. Now, you go ahead and you calculate surplus cash again at June 30th, and you have 20,000 surplus cash. There are owners who think they want to be able to distribute the full 25,000. That is not possible. The only thing possible, because now that cash that you left undistributed was still in cash, and it became part of surplus cash at June 30th. So therefore, all you can distribute in the next 6 months is $20,000, and for the year, you would be limited to $30,000. I mean, $35,000. But the client's can argue, well, I was due 40, and the only way you can get the extra 40 out is if you move, and this is why we would always do this. The minute we calculate surplus cash at 12/31/19, on January we would move all of that money to entity cash. And then whenever the client takes it, they can take it. And then when we get to year end, or I mean to mid-year, oh geez, Les, mid-year, we would calculate surplus cash again. Now, in theory, it doesn't matter much, Paul, because if you move the surplus cash out, all you really say, into entity, you're just making sure the cash is gone. So the same amount of cash is being generated one way or another. But that's the goal. And I can't write that on here for any reason whatsoever known to man. So I can't make that work. Why I can't right now? I could do this all day with it not online, but when I'm online, it screws up. So that would be the case in most of in this calculation. Okay, Michael, can you classify surplus cash as not taken? No. Never, 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 ever that. And let me tell you why. So the question you see in the Q&A is, can you classify surplus cash not taken as a payable, like dividends payable? Or are the liability accounts for notes payable surplus cash for loans or advances from ownership? That is exactly what those are for. You'd never, 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 ever want to accrue as a payable the surplus cash. That is just not done. So what we're saying is you just take the money out when you can, and we do not put it into payables, because if it goes into the payable as a surplus cash at year end, then it's only payable from surplus cash, and you deduct it from surplus cash as a payable, so you've made it extra hard to include that, because all those things are just simply payable. Okay, this is a conceptual challenge here, isn't it? Does entity cash only relate to HUD projects, or does it apply to other multifamily clients? From a perspective of, say, RD, they do not allow their chart of accounts to include entity cash. Now, other projects, clearly non-regulated projects, would maybe have entity cash, but the question you're going to get out of that is why. If there is no restriction on distributions, why segregate cash at all? Because we can take money out of the project anytime we want. And so most of the time, if you had debt covenants or other things of that nature that would require you to list or to make a certain ratio or something like that, there wouldn't be much motivation to separate them anyway. So as a general rule, this is mostly a HUD thing, okay? Most people don't keep entity cash anyway. They distribute money and take it completely out. So the owners take it. It's a taxable event to the owners. However, we do see management agents all the time withholding that money, calling it entity cash. It's a good process for HUD, just simply because we don't want to get caught up in either giving away money we'd already earned, okay, or the project wants to retain it but wants to be able to spend it on what it wants instead of having it tied to the regulatory requirement of reasonable business expenses. Now, why they're not really that different, but that's just the difference, is to classify, claim what you can claim, segregate what you can segregate, live under the other rules, okay? So I wouldn't put it in payables at all, ever. That is for things that you've, like owner advances or other notes that are only payable from surplus cash. And Brandon, I don't think, frankly, although the concept should apply equally, it just doesn't matter once you get out of the regulatory side. And then Paul, I think we've gone over that question. Because once you recompute surplus cash at the next 6-month interval, any remaining cash that was not segregated or taken out one way or the other, it rolls into cash again. Okay, boy, excellent questions. I'm glad we're getting those filled out for you. We talked about reasonableness, and we talked about the hierarchy. Well, hierarchy. The reason the regulatory agreement has expanded is because we've put the other things back up into the regulatory agreement. So we took handbooks and other things and put it up into the HUD requirements. Now, handbooks, we're not going to get into each of these, but financial operations, this talks about cash receipts, cash disbursements, controls, the basic cash accounts. However, this handbook does not apply to HAP contracts. Okay? If you look at the applicability thing in there, but this is kind of what that handbook is. Handbook 4350.1 talks about asset management and project servicing. We get from there the rules on reserve for replacement. We get the rules for residual receipts. Other things that HUD manages out of there, like increases, what kind of things have to be investments and things of that nature. 4381.5 is the management agent handbook that governs the behavior of the agent, what fees can be charged. We'll talk mostly about that in the next session. And then the occupancy guide is where we discuss really the ins and outs of running a tenant subsidy program, a Section 8 program. Now, when data goes to REAC, you submit a submission, and if I'm going to just pull up a sample of one of these, let me see what I have here. Shared folders, submission multifamily. I didn't click on the right thing there. Do I have one that looks like we're ready to have something here? Okay. Now, this is going to open up where? Oh, something's wrong. That's what's wrong with my PDF. Something's broken on PDF. Oh, a drawing error occurred. That's what happened. Okay, now, this is what the data looks like when it gets to REAC. It's all in one big line. There are no subtotals. Everybody has to enter every subtotal. The details come down and show under each account. And so this is just one huge line of data. When it gets to the footnotes, it's just one big block of text. You see what Kathy does here is we insert 5 underbars so we see how the paragraphs may flow differently. So all this data goes to React, and this is exactly what it looks like. It's really hard to read. The block of text don't format. It's all just one big happy mess. Okay? So when that happens, we enter it, we validate. If you get it to validate, it gets submitted to React. They produce a series of assessments. And those assessments can result in a couple of things. And in fact, one of those things I thought was interesting. I would show this one today. Hang on. Let me move my mail here in a second. I got this one this morning, and I thought this was an excellent conversation. Now, it does contain a project's piece of information in it, but what it really says is this. We reviewed you. We conducted this initial review of your statements. We found no noncompliance issues. A secondary review has been completed, and this message serves as your record that the annual financial statement is complete and we have no further questions. This is the goal of everybody. This is what we would call, a no comment letter. And they send it to the client, and it's good. If not, and this one might have gone to step 2, over to the analyst for assessment, then they could have sent you the letter, or it could be sent to DEC, or it could be referred to the field office for further review. And it all depends on what really happens in the assessment. Now, they calculate a ton of analytical review. They calculate a score. And that score will be assigned to the project. It will be a red, yellow, or green, and they will never tell you that score. That is not something they will disclose to you. So they make all these assessments, and the analyst is supposed to review the material and decide. And you can see that only about 43% of the submissions are closed automatically by FAS. Another 19% go to the analyst and are then closed. 30% are referred to a field office to say, look, you guys need to worry about what's going on with project A. And about 8% are so severe they go to enforcement. Now, just one little comment here. The typical limit to get that kind of attention is anything over about $10,000. So materiality, I mean, when you think about it, React's materiality is about 10 grand, okay? So that can be a big deal. And this is how the review looks to us. Now, the review starts off being about the financial statements, but what it typically turns into is a review of the auditor. Now here's one where we've generated a bunch of compliance flags. The system generated 5. One of those was big enough to go to enforcement. So EC is Enforcement Center. It's also known as Departmental Enforcement Center, or DEC. And the auditor generated no findings. So now this becomes a little bit of a conversation about how good or bad the auditor is here, okay? Now this one is a little worse. This one's actually worse. These are actual screens from how this gets reviewed. So the system generated 3 findings: unauthorized loans, unauthorized distribution, and we'll talk about what generates that. And you didn't make all your reserve for replacement deposits. 2 of those are significant enough to be enforcement referrals. The auditor generated 4 flags. Why is this worse? Because the auditor coded the 2 findings that relate to these 2 things. It was a he coded them to Z other. And the fact that they were not coded correctly according to the coding scheme in REAC was viewed as an attempt to hide the fact that the client had done those things wrong. The last one that was generated, the residual receipts, the system can't know that. Only the auditor can tell you. And this guy got referred to QUAS as a potential fraudulent auditor. Now, there's no basis in reality for that. I'm here to tell you what the auditor did. They didn't know the codes. They were late at night. The system was bad and slow. It's on the last day. And they got down here and just entered that. The other, they didn't know what to do. It was a person who didn't know what to pick, and they just entered it. But HUD thought it was a big thing. So my point is this. They are all the time focused on their system. They're not looking at your financial statements. They're looking at the codes and the other things that drive their behavior. And they can misinterpret things all of the time. And this is a huge risk for us in that regard. And then, now, most popular things, and these are generated automatically. You can clearly see unauthorized distributions as equity skimming, unauthorized loans of project funds, underfunded security deposits. Now, what happens automatically to refer you to DEC? And we'll end with this one right here. We're getting kind of close to our HUD audit guide break. This is the next one before we go to the HUD audit guide. So HUD audit guide is really just the next day. Anytime that the system detects that you didn't pay your full mortgage, you didn't fund your reserves, you change project ownership. Don't ask me how that happens, but it does. You disposed of project assets or distributed things beyond surplus cash, you will get automatic flags to refer you to DEC. And that is what these system items are noticing here. Automatic enforcement referrals. So these are the audit things that would automatically put you into DEC, as long as they're over $10,000. Now, that is a pretty big summary of what happens. I'm glad we've cleared off the Q&A. I'm 2 minutes over my limit. Now, the HUD audit guide we will address next time. So part B will be the HUD audit guide. And most of it will be chapter 3, but there's a little bit here on 1 and 2 that are the next 30-something slides that are pretty easy to get through. So I don't have any other Q&A or chats. Michelle, do you have anything else for us at this time? Oh, we just got one earlier. Angela, I'll tell you what, we're going to do that in the next class because I want to deal that with the HUD audit guide in particular. That's kind of where that fits. But I will have a specific mention in the notes today to do AUC 725. So if you're on to the next class, part B, I will do that. If you're not, then email me and we can have another conversation about that. But I think that fits into the next session of the HUD audit guide, and we can discuss that because I have to talk about sampling materiality and a couple of other things that fits right there. Okay, if there's nothing else, folks, you've been great. I appreciate all the comments today, the Q&A, the questions are awesome. And but we're kind of getting to the end of our 50 minutes here, or 200 minutes. Yeah, Yvette, you can send me a specific fact pattern to discuss, absolutely. It's just les, L-E-S, at ahacpa.org. Okay, I might not get to it. I've got a couple of phone calls pending here in the next few minutes, but I'll get to it today. if I possibly can. Okay, Michelle, anything you want to bring up?
As always, just a reminder that CPE certificates will be emailed to you within the next 3 business days.
We'll see you on part 2. Thank you very much. Have a good evening.